to reverse out in the August and September data. So I do think, of course, markets are probably going to see that negative retail sales print, see it as another point of soft data that's going to worry them, but we're staying calm, stay calm. We're probably going to see that reverse out in the next two data prints because of seasonal factors. And then the last one I'll mention, of course, is going to be the CPI print that we get also next week. We're looking for 0.2% on core CPI and 0.2% translation into PCE inflation. And that's very much in line with the continued trends to get the Fed to cut in September. Of course, markets are going to be very sensitive to any type of upside, maybe saying that it's stagflation, and any type of weaker print saying that this is just further evidence that the economy is slowing too much and the Fed needs to cut more.
I'm not sure anyone can handle a conversation about stagflation next week. Let's hope that's not the conversation we're going to be having. Sarah Wolf there of Morgan Stanley. Looking ahead to CPI next Wednesday, there's a very simple bearish story to tell, isn't there? Companies are losing pricing power, sales are sliding, margins are at risk, you start cutting costs. Is labor at risk? That's the conversation we're having going into jobless claims. Coming up next, at a second hour of Bloomberg Surveillance, Dan Greenhouse of Solis, James Lucia of Capital Alpha Partners, Bloomberg's Charlie Wells, and Tony Rodriguez of Nuveen. From New York, you're watching Bloomberg TV.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
We want to make sure that we're exposed to categories that continue to be relevant to consumers, that we're positioned in categories where we have a competitive right to win.
By strategically adding and shedding assets, General Mills has turned over about 20% of its net sales base in the last 6 years. It's dramatically expanded its pet food platform, starting with the purchase of Blue Buffalo pet products in 2018. That expansion dovetailed with a boom in demand.
Pet in the U.S., pet feeding and treating, is a $50 billion category. It's almost 5 times the size of a category like cereal.
Is this the future of the company? I mean, we so much associate General Mills with breakfast and cereals, human breakfast and human cereals. Are we now going to be thinking about General Mills much more as a pet food company?
I think you'll be thinking about General Mills as a food company where we treat all the members of the family like family.
The humanization of pets is actually the biggest driver of pet food and pet treating growth. It has derivatives in not only feeding, which is the core thing that you know most households where most of the dollars go against the pet, but treating, and then you start to branch out to things like vitamins and minerals and supplements.
People really love their pets. They want to take care of their pets like they do their family, and it really is a global phenomenon. That's why we recently entered the China market with Blue Buffalo. That's why we bought Edgar & Cooper recently in Europe, because we see the same kinds of trends that have played out here in the U.S. playing out all over the world.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
If you look at the fundamentals, at the macro data, yes, it has been weakening a bit in the US, That is not a disaster from my point of view.
The problem here is when the labor market starts to deteriorate, confidence starts to decline.
We're in one of those classic moments in financial markets where the prices have changed more than the facts have.
I think the market has slightly overreacted in its assessment of a recession.
The markets are often wrong about what's going on with the economy and what the Fed is going to be doing.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now. Let's do two things, a flavor of the price action, and then we'll talk about the data point that everyone's talking about. Equity futures right now on the S&P 500, a little bit softer, but recovering. We're down 0.1% on the S&P. The Russell, down 0.5%. Here's the data point that everyone's talking about. Why are we all talking about it? Jobless claims always matter, but it matters that much more this week because it's all we've got. Jobless claims right now, the estimate 240,000, Danny, the previous number, 249.
Just listening to Sarah Wolf, I'm starting to worry about how much importance we're putting on this because she said, look, this is a data point that's still going to be extremely seasonal. You're still going to have issues in it, like that of last month when you had a lot of weather-related claims coming in. So what happens if this market panics and then we get next week? What happens if it comes weak and then next week you get strong data to the good way? I mean, again, whipsaw, more of it.
Well, let's talk about the totality of the data. Let's go on the data of the last week or so. Does it confirm or deny the growth scare that everyone seems to be talking about at the moment? ISM services, clearly denied. Back in expansion territory, new orders, business activity, pretty decent. ISM manufacturing clearly confirms the employment component of that, the worst since 2020. Payrolls confirms the unemployment rate, I think, the highest since 2021. And that's the game we'll be playing, confirm or deny, going right the way through that to that Federal Reserve decision on September 18th.
You get the feeling, though, that the market is putting more of an emphasis on the bad data, that you do have a market that's more willing to react in a volatile way. And that comes back to this positioning conversation that we've been having. But if you have yields back right around to where they were before the Friday's job number, which is just remarkable, by the way, considering the chop that we've had, does that mean that we could have this time around, the bias is a reaction either way, that you could have big swings? Again, for the most part, it's more the bad data that we decide to swing around, but it's anyone's guess this time.
But when you think about a growth scare, you are seeing banks start to up their probability potentially of a recession overnight. That was JP Morgan. They're upping their probability, and they talk about hints at a sharper than expected weakening in labor demand, early signs of labor shedding. But something Sarah Wolf said that also Torsten Slok talked about yesterday, which was this, everyone talking about the Somm rule. What Claudia Somm is saying is that it doesn't really work this time because look at the supply we've had in the increase of immigration into the United States.
We'll keep going back to the calendar as the path to September 18th of the Federal Reserve and work backwards. The data and what else you need to be looking at the moment. Payrolls, that comes up on September 6th. We get some CPI data on the 14th of August and September 11th. And of course, you get Jackson Hole on August the 23rd. So Chairman Powell's got a bit of time here, Danny, to work out what he wants to say in Jackson Hole. I imagine that speech isn't written just yet, and we've got to wait for the data next week as well.
And this is where the criticism comes in that Mohamed El-Erian has been talking about, that the Fed doesn't have a coherent economic policy framework. And if they did, then maybe Powell could have already written a speech and he wouldn't be swayed by each individual data point that comes in. But the fact that they don't have that means that they need to be so data point dependent. And again, the criticism goes that they're being blinded, that there is a clear trend developing, but they can't see it because they care so much about the individual releases.
We talked lots about the equity market. Let's just touch on the bond market just briefly. A snapshot of where the 10-year is trading following that soft auction yesterday. Yields coming back in just a bit. We're down 3 basis points on 10s, 391 on a 2-year at the front end of the curve. We're down 2 basis points, but still about 30 basis points higher from where we were at the lows on Monday morning. We're trading in the 390s on a 2-year this morning. Coming up this hour, here's the lineup for you. Dan Greenhouse of Solace with stocks falling ahead of jobless claims. James Lucier of Capital Alpha Partners as the election swing state tour rolls on. And Tony Rodriguez of Nuveen on whether the rally in treasuries has run out of steam. We begin with our top story. Stocks edging lower going into jobless claims at 8:30 Eastern Time. Dan Greenhouse of Solace writing this. The economy is clearly slowing, but I don't believe we're already in or immediately at risk of falling into a recession. Dan joins us now for more. Dan, let's get straight into it. Why?
First of all, I'm upset because everything you guys said in your intro was the points I was going to make.
We can pretend it didn't happen if you want. But start again.
But that said, I think we're obviously having a growth scare right now. That's not breaking news. But I also think we're putting a lot of weight on one data point. And to borrow a phrase you used, one of many I was going to, about the totality of the data, it's one singular data point that I would argue, and I'm not alone, but I would argue was probably impacted more by Hurricane Beryl than the BLS immediately led on. I think there are a number of data points you can point to. We're well aware of them at this point. The most obvious one being the number of people not at work due to bad weather, which spiked during the month. That doesn't necessarily impact the unemployment rate per se, but it does indicate that there was something going on in the month that I'm not positive the BLS captured in its initial release.
When you look through the calendar and look ahead to the next payrolls report, September 6th, do you think we're at real risk of seeing the story flip the other way all over again?
Well, listen, the other point, you know, getting back to your first question about why I thought we're not imminently or immediately at risk of falling into a recession, when you look back at previous downturns that eventually become a recession, it takes months and months and months to go from creating 200,000+ jobs to losing jobs. You have several months where you have double-digit job growth, 80, 70, 50,000 jobs. Maybe you print negative once or twice. That was the case before 08. That was the case before 2000. It was the case back in the 90s when you started losing jobs right when the recession began. We're not there yet. 114,000 jobs, not a great report relative to recent history, but outside of recent history, I think 19 years into an economic expansion, or however long this has been, 114,000 jobs created would have been pretty good.
I think this is such an interesting point because on Monday, if you ask
That's
people,
why I made it.
Yes, a lot of people would have said, oh, we're here. It's happened. The recession's around the corner. If it takes months and months for it to actually happen, what about the time frame when we can say it is going to happen? Is that too soon still? Or can you say, okay, it's going to take months and months, but looking down the barrel of those months, it's going to come at some point?
Well, yes, at some point there will be a recession. we can all agree.
Okay, some point in the next year, let's say.
But listen, here's the problem that you have in a free market capitalist economy like the United States is it's incredibly difficult to know when this is going to happen. If we were in China or some command control center economy, you basically you have a better idea because the state is in control here. We've got millions of actors operating throughout the economy independently of one another. There's 50,000 economists staring at the same data in the United States for all of human history, and none of us, and I'm not an economist, but I'll play one on TV for now, had been able to accurately forecast a recession. And my favorite observation on this topic is 3 or 4 months into the recession in 2008, there was still a debate about whether we were going to have one, and it had already started. It's an incredibly difficult endeavor to embark upon. I don't think this time is going to be any different. All you can look at is the totality of the data and try to come up with a framework for how I should invest in given moments. And to the way that I view things right now, we're obviously slowing down. We're returning to something resembling trend growth, certainly in the labor market for the economy more generally. And from an asset allocation and investment standpoint, what do you do in that type of environment to the best of your abilities?
What do you do in that type of environment?
Well, listen, right now, we still, I've mentioned multiple times, we find and have found stuff to do in the consumer-focused space. I've faded the excess savings argument. Obviously, that narrative is changing somewhat lately. Many more companies, Dynequity reported yesterday about a slowing consumer. Disney had some trouble in the parks, although that's not entirely surprising considering how much it costs to go to Disney. But there's been a more widespread observation about a slowdown at the lower end of the consumer space. So you have to pay a little bit more attention to that idea. But we've also liked energy. Oil has been flat for, call it 2+ years. I'm not sure everybody's aware of that, but within that context, a lot of the energy names which have focused on shareholder returns have done pretty well, from the integrateds on down to refiners and services, et cetera, et cetera. I don't know that I need to change that whole cloth right now on the idea that one labor market report wasn't as good as I'd hoped.
But you even note in your notes that we got that in contrast to Dine, Hyatt is basically saying, actually, they are seeing some pretty strong bookings. So how do you really read what's going on with the consumer?
This is the ever-present problem for people such as myself who look at markets from both the top-down and bottom-up perspective. You can look at McDonald's. You can look at a number of companies that say, hey, so Visa, my favorite large market indicator, saying, yes, there's trouble at the low-income consumer. But for every McDonald's, I can give you a Chipotle. For every Dine, I can give you a Hyatt. Hyatt talked about group bookings looking incredibly strong. The casinos, the stock prices are well off the highs, but Vegas seems to be doing pretty well. So there's a lot of cross currents that you always have to deal with. I don't think now is really any different. Although, again, I think how I've looked at markets and the economy over the last 2 or 3 years, let's say, with a relatively sanguine or optimistic outlook, certainly has been tempered over the last couple of weeks by some of the data and earnings reports we've heard.
You like energy. Is that by any chance an election play?
No, and we talked about this last time I was here about the surprisingly energy did quite well under the supposedly anti-oil administration of Biden, and the converse happened during Trump. I think for us, it's been the focus on shareholder return relative to the credit markets was at many points equating some of the equities to some of the credits. It's the underinvestment. It's the exodus of people from investing in energy in the wake of what happened in 2014 and 2015 when energy imploded. It's the underinvestment. It's a number of things that we think are structurally supportive of the energy market. The U.S. is pumping 13+ million barrels of oil per day. We're doing it with a third as many rigs. It's really, there's a lot of encouraging stuff going on in this space that we still find attractive.
It's pretty impressive. You were talking about energy there, and you talked about equity versus credit. As you look at the broader set of opportunities at the moment, the ones you've identified, when you look to express them, you're seeing more opportunities in credit or equity after the reset of the last few days?
Yeah, I mean, we've been spending a little bit more time than usual the last few days on that relative argument. I think things have gotten obviously a bit more attractive. The S&P is down 8%. Obviously, tech, which is not a particularly large focus of ours, is down 10% more. Spreads have widened from very low levels, still very low for IG and high yield, just off. I don't know that the relative value argument has changed over the last couple of days, but the opportunity set has certainly widened. We spend a lot of time and have historically spent a lot of time in the media space. It's public knowledge. We were a large owner of MGM before the purchase. We've spent a lot of time there. You look at things that are going on with Disney finally turning a profit on the streaming side of the business, what's going on with Paramount and Warner Brothers, with Wolverine and Deadpool, one of the highest grossing R-rated movies of all time. There's a lot of stuff going on in there, and it's as interesting as it's ever been in an environment where there's a lot of fluctuations going on. Yeah. We still think there's tons of opportunity around that.
Can we just get to 35,000 feet and talk about high yield spreads, just briefly?
Sure.
We sit here and people will come on the program and say spreads are too tight. And that kind of makes sense when you're at 300. And then you get a widening back to, say, towards 400, in and around. After that first 100, the same people who said the spreads were too tight and waiting for an opportunity to get in will sit here and say, I'm a little bit nervous, you've got another 100 basis points of widening
Well,
here.
the same people who say buy the dip and then the dip shows up and they run to the hill.
The same thing applies to credit. I'm just wondering, how do you approach that kind of dilemma that a lot of people have to confront in financial markets?
Well, the first thing I will say for the viewer that doesn't follow the high yield space, other than people who come on TV and point to the HYG, the high yield market is now roughly, a third of it is now roughly secured. So by definition, it is a higher quality market just from the security standpoint. So you're going to have tighter spreads as a result of that. It's also much more highly rated. Those are going to be related, of course, but it's a much more highly rated market, whereas the IG market is much more rated and leans towards the BBB, the lowest rated rung. High yield is much more leans much more to the higher rated rung. So there are structural reasons why the spreads don't have to necessarily compare to history. It's sort of akin to when you look at the stock market and you look at valuations. Yes, the equity market is more highly valued 20, 21 times relative to its history, but you're disproportionately more highly weighted to tech stocks, which of course come with a higher valuation, so you're going to have a bias to the upside there.
And in junk, we used to be more highly rated towards, say, the likes of energy. Has that changed too? Are we less cyclical in high yield now, as you look at things?
Well, listen, energy is, this is a conversation for like the debate between high yield and loans, where high yield, the other thing about high yield is energy used to be a much larger part of the space, but everybody went bankrupt or graduated into IG. So energy and that one area that's constantly been a problem for high yield isn't as prevalent today as it was historically because of what we went through in the middle of the 2010s and then in COVID. But from our standpoint, again, the recent sell-off, arguably unjustified from our standpoint, has opened up a couple of more opportunities that previously might not have been there because of how tight spreads were or how highly valued markets are. But I also think you need to be a little careful here for the reasons that we talked about earlier. The economy and the jobs market and the risk landscape is not exactly the same as it was several weeks ago, certainly, and several months ago, more assuredly. There's just, I think you're in one of those moments where in the previous months, I'm very optimistic. I've faded a lot of the more bearish arguments. I don't think you can do that as easily now.
Interesting. Appreciate the clinic. It's good to see you.
Always my pleasure to come, guys. Thank you very much.
Thank you, sir. Thank you. Dan Green has there of solace. Let's get you an update on stories elsewhere. Let's get you the Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. A tsunami advisory has been issued for parts of Japan after a 7.1 magnitude earthquake was reported off the coast of its southernmost main island, Kyushu. Officials in Japan say the quake occurred just before 5 p.m. local time at an undersea depth of about 18 miles. Local residents were warned to leave coastal areas immediately. There have been no reports of any structural damage to buildings so far. Eli Lilly shares are rallying in the pre-market, up 10% after the pharma company boosted its revenue guidance for the full year, now projected to come in well above the average analyst estimates. The increases were primarily driven by strong performances of diabetes medications, Mounjaro and Zepbound. The company plans to launch single-dose vials for Zepbound in the coming weeks. And NASA is now saying the 2 astronauts stuck in space due to problems experienced by Boeing's Starliner may have to hitch a ride back to Earth on a spacecraft built by Elon Musk's SpaceX. NASA representatives announced the contingency plan yesterday, saying astronauts Barry Wilmore and Sunita Williams will come back to Earth around February 2025 on SpaceX's Crew 9 mission. Originally, the 2 astronauts were supposed to stay on the station for roughly a week, but have now been in orbit for 2 months. That's your Bloomberg Brief. John?
You thought delays at the airport were bad. Can you imagine that? They'll pick you up in 2025. It's a bonkers story. Up next on this program, courting the union vote.
To me, this election's real simple. It's about one question. It's a question we made famous in the labor movement. Which side are you on?
That conversation up next, live from New York this morning. Good morning.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Equities on the S&P look a little something like this. We're just about positive, erasing this morning's losses, just about positive. In the bond market, a bit of a rally, not much of one. We're down 2 basis points on a 10-year. After the rally you saw Monday morning, I don't think you can call anything else a rally when you're just moving a couple of basis points. 392 on a 10-year. Under surveillance this morning, courting the union vote.
To me, this election's real simple. It's about one question. It's a question we made famous in the labor movement. Which side are you on? So on one side, you got a billionaire that serves himself and his billionaire buddies. And on the other side, We got a strong, intelligent, and I'm just going to put it bluntly, a badass woman.
Here's the latest. Kamala Harris calling on United Auto Workers leader Shawn Fain to speak at a rally in Michigan, underscoring the importance of the union's endorsement of Harris in a key battleground state. Harris continuing her swing states tour with a stop in Arizona next, while former President Donald Trump rejoins the campaign trail with a rally in Montana tomorrow. James Lucier of Capital Alpha Partners writing this: I expect Harris will open a lead over Trump after the Democratic convention, but the race will tighten in September. James joins us now for more. James, let's get straight to it then. Where's that race tightening coming from? What are the forces behind that you expect in September?
Well, there's always a bounce when a candidate has a honeymoon period. There's usually a bounce going into a party convention, which, let's face it, is a 4-day infomercial for the party. The balloon drops, the excitement, the celebrity endorsements. So Kamala Harris has already done quite well with her initial announcement. She's had a flawless rollout. She's had a good honeymoon. And she's also benefiting from what I would call a relief rally among Democrats who realized that there was literally no way Joe Biden could win after the debate. It became clear that he was really a greatly lessened candidate, even than he was 2000. So she's benefited from Democrats coming back. On the other hand, though, once the initial rush is over, people will be focusing on issues again, not just the excitement of newness, but immigration, inflation, the crime, the national security, and those core issues where, you know, even though Biden and Harris were tied in the national polls, we're still seeing, at least so far, polling on issues, whereas Trump tends to lead on key issues like immigration, economy, and national security, law enforcement, whereas Harris generally does much better on things like abortion rights.
So, James, when it comes to her VP pick, is this someone that could potentially help her in those top two issues that Trump does better on, immigration and the economy?
I don't think so. I think that he is a safe choice and a good choice who may help in the upper Midwest, certainly may help deliver key states like Michigan or Wisconsin. But just as J.D. Vance was the safe choice for Trump, I think it's also the case that Walz is a safe and comfortable choice. Not that it's a bad choice, but I think that there might have been a greater upside with a more centrist candidate and somebody who was frankly the rising superstar of his generation, who is Josh Shapiro of Pennsylvania. The problem is, of course, has become very evident in the past couple of days, Shapiro is not going to be on the ticket as a second banana. He probably would have overshadowed Harris. So going with Walz is probably better, all things considered, at least for Harris.
There is this consensus that Governor Walz of Minnesota could speak to those in Michigan, to those in Wisconsin. Do you believe that?
Well, it depends on speaking to who. In Metro Detroit, quite possibly. Michigan is a state, like most other states, like Minnesota, where you have strong urban populations, which are very solidly Democratic, and then you have very conservative rural, small-town portions of the states. So, you know, I don't know if he's going to be a game changer in Michigan. Clearly, he's got a profile rather similar to that of Gretchen Whitmer, the popular governor, same abortion background, same focus on COVID and COVID prevention. But we'll really have to see whether he is someone that can excite the UAW. You know, one of the key concerns with the auto workers has been that the move to electric vehicles is going to obsolete their jobs. And Walz is clearly someone who is a very strong proponent of the green agenda and the green energy agenda that a lot of union workers are simply uncomfortable with.
James, though, these concerns, they all seem in the background, at least for the campaign at the moment, as they don't really address them, just riding this wave of enthusiasm. When September comes around and the polls do tighten, are they going to need to change?
I think that we'll have to drop, you know, I think certainly for Harris, she needs to start doing interviews at some point. She needs to start talking about the issues. with the campaign where we're down to about 90 days to go, every day that you can win simply by doing nothing, by having photo ops, by having rallies, that's a day that you can bank. But we really haven't seen the Trump campaign respond yet. And I expect that they will. I think that they're going to focus on these core issues. And they've got an enormous war chest, in terms of money they could use on television commercials and direct media. So at some point, this Trump response is going to come. It likely would come after the Democratic convention, because otherwise you'd be shouting into the wind. Elections tend to become very, very competitive after Labor Day when people start paying attention, and also early balloting starts.
James, appreciate it. As always, thank you, sir. James Lucy there of Capital Alpha Partners. I've got a structural bias. As a journalist, of course, I want to see one of the leading candidates sit down and actually answer some questions. It is remarkable that we haven't seen that happen in much of the last 3 weeks.
It is, but to James's point, any day they can go out, have a photo op, get thousands of people to come to your rally, you bank that as a good day. She's not being forced yet, and I think that was J.D. Vance's point yesterday, going over to Air Force Two.
Trying to get the media to put some pressure.
To the media to say, don't you want her to sit down and have an interview? But at some point, she's gonna have to. Also, another thing he said, when it comes down to the issues, it's Trump.
It's not happening right now. Coming up on the program, shares of Warner Brothers Discovery tumbling in the pre-market, the company writing down the value of its TV networks. That's next.
A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything.
Or other authorities.
Could face bigger challenges next.
It was going to keep rating World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
For those of you following the political campaign, just a note for you, 2 p.m., Mar-a-Lago, the former president of the United States, Donald Trump, will be doing a news conference. That's one to watch a little bit later this afternoon. For the rest of you following the economy and financial markets, we are 60 minutes away from jobless claims in America, and the scores going into it look like this. Equity futures just about unchanged on the S&P, just about positive on the NASDAQ. As things stand on the S&P 500, heading towards a fourth week of losses. If it holds, if it sticks, I think that's the longest weekly stretch of the year so far. That's the equity market. In the bond market, really the epicenter for some of the nerves yesterday, just a sloppy, soft 10-year auction. We get a 30-year auction a little bit later this afternoon. 30-year supply coming at 1 p.m. Eastern time. Yields coming in across the board here. We're down about 2 basis points on a 10-year at 392.45. And just to round things out with dollar yen, the move high yesterday in dollar yen, we retraced some of that. Dollar yen down by about 0.5% at 146. Some encouraging words to, was it to sell the Japanese yen yesterday? What do they want us to do with the Japanese yen over in Japan? Because now I'm just confused.
Presumably just not swing. I mean, either direction. I feel like that's what they wanted, but they kind of didn't get that. Because if you have a deputy governor coming out and saying, we're not going to hike rates as long as things are volatile, you get a market that, one, continues to test them because the yen will do that to you. And two, you get a swing in the other direction because people say, oh, great, it means that they're not going to hike. They're not going to hike. Therefore, we can go back into the carry trade and wonderful, everything's as it was. But is it? I mean, we had Bank of Japan minutes. It doesn't suggest that we are.
Story's changed in about a month, hasn't it? Because when we were back at 160, they wanted you to buy the Japanese yen. Dollar yen was too high, the yen was too weak, and then we gapped lower through 150 into the 140s, and it's no, we don't want that. We don't want that. What do they want? Stability around what? They just want this gradual smooth path back towards 110, 120?
Presumably, and presumably they don't want all the speculative shorts in there. Presumably they don't want this buildup of a carry trade. So couldn't you say, okay, Monday was painful, but maybe it was a good thing for them? Maybe they wash out all this excess positioning that allows the currency to bounce like that. So it's interesting that they come back out and undo some of that work.
It's the latest on dollar yen, just about 146, 145.99. Under surveillance this morning, of course, we're counting it down to jobless claims at 8:30 Eastern time. The median estimate in our survey expecting a print of 240, down from 249 last week. Following that, we'll get some Fed speak from Richmond Fed President Tom Barkin at 3 p.m. Let's deal with the data. I just received some of my favorite data. It comes from Bank of America and the Bank of America Institute. Consumer checkpoint, facing hurdles or the high jump. There's some great data in here. If you can reach out to B of A, reach out to B of A to get hold of it. But I'll share some of it with you right now. They say while the labor market is showing some signs of cooling, after-tax wages and salaries continue to grow, and there's no obvious signs of a surge in joblessness. A small uptick in year-over-year growth of households receiving unemployment benefits through direct deposits across all income groups, just a small uptick. Then the one that stands out for me, and we covered this with Brian Moynihan a number of months ago, this always surprises me. Median deposit balances remain almost 40% above pre-pandemic levels and over 15 percentage points above inflation-adjusted 2019 levels, but they have declined to near their lowest post-pandemic levels. So deposit balances are still pretty high. But if you're interested in the trend and where things are heading, you have to acknowledge that things have come in a little bit over the last few months.
That's what everyone's been arguing about all these data points. The level is fine, but the trend is worrisome. But you know also who else has had the same tone that Bank of America is talking about is Jamie Dimon. Jamie Dimon was speaking yesterday and said he's even skeptical that inflation is going to go down to 2%, that he's been looking at his own internal data and credit card losses have normalized. That trend has stopped. So he's over here worrying about inflation. Here we all worrying about the labor market. What happens if next week CPI comes in hotter?
This is why Mohamed El-Erian has been saying the Fed should be targeting a range of 2 to 3%, so they have a little bit more flexibility. Looking at this data as well, Jonathan, from Bank of America, services spending was stronger than goods. International travel, this is pretty much what we heard from the Disney CFO yesterday, and why potentially they're dealing with some of their parks not getting as many visitors, remains a highlight. Consumers flocking to Paris Olympics and Taylor Swift conference, but they do see consumers becoming more price sensitive, something else we've been hearing constantly on these earnings calls.
The next big stop for this conversation, not just got jobless claims in about an hour from now, but also retail sales. Danny's talked about that repeatedly. That's a week today. Retail sales is just around the corner. The day before that, you'll get CPI. The day before that, you'll get PPI. So next week is quite a week for economic data. I want to turn to this story. Iran's president telling his French counterpart, Emmanuel Macron, that the United States and Europe must push Israel to accept a ceasefire in Gaza to reduce tensions in the region. The call is the latest in a wave of diplomatic activity to try to cool tensions, with Israel bracing for retaliation following the killing of a top Hamas leader in Tehran. We've been bracing for that retaliation now for the best part of a week.
And we're trying to read the tea leaves that what's coming out of Iran, but also what's coming out of Lebanon. And we heard from Nasrallah yesterday, but before he spoke, this is what's interesting, and Axios picked up on this. There was an editor-in-chief of the Lebanese newspaper publishing a front-page article that said Hezbollah is likely to target Tel Aviv as part of its response. And there's more reports yesterday, Jonathan, that maybe before Iran responds, we'll actually see a response from Lebanese Hezbollah.
How much pressure are we getting out of the United States at the moment from the White House?
I think there's a lot, but it's been behind scenes, behind closed doors. And I imagine there's a ton of pressure from the United States to go directly to the European counterparts like Emmanuel Macron to put some of this pressure on Iran.
That's the latest in the Middle East. I just want to check out one stock. Warner Brothers Discovery is down in the pre-market by more than 10%. We're negative 10.5 this morning. Shares tumbling as the CNN and TNT parent company writes down the value of its TV networks as it deals with the ongoing exodus of viewers from cable to streaming services. Bloomberg's Charlie Wells joins us now for more. Charlie, fantastic to touch base with you, sir. Can you just walk us through the difference between a bad market and poor execution? Where is this company at the moment?
Yeah, I mean, I think the market is still digesting what they were hearing on yesterday's earnings call. And I think, you know, management was very clear to talk about the difficulties, not just in this company, but also in this market. But when you look at that write-down, over $9 billion, I mean, that figure itself is really striking. But you've also got to step back and remember that Warner Brothers Discovery tie-up is only about 2 years old. So how is this happening so quickly? How is that secular trend that we know about of people moving on from cable, how is that happening so quickly to the tune of over $9 billion in just over 2 years?
Charlie, how much of this is also just about the advertising market? I mean, advertisers have a lot more choice now. They got a Netflix tier, they have a Disney tier, they just have more that they could go to besides linear TV.
They've got a lot more real estate. And I think what's also frustrating for these companies is that they are getting advertising on streaming. And when you think about streaming at Warner Brothers, when you think about streaming at Disney, they're actually performing a lot better than people expected. But the issue here is just the bulk of revenue for a lot of these media companies comes not from streaming, but from that terrestrial television where the ad dollars are just stronger.
Well, one of the advantages that they did have in the past, Charlie, was a monopoly over live sporting events, and that's changed. Where do we stand on the competition to show those programmings?
Yeah, I mean, this is the rare bright spot in terrestrial programming for these large media companies. And of course, we know that with Warner Brothers, there was that disappointing for them decision for the NBA to go elsewhere. They're in the midst of litigation, and this was a hot topic on the earnings call yesterday. Of course, management saying they think they have a strong case, but of course, it's working its way through litigation right now.
Charlie, Bank of America put out a note about Warner Brothers Discovery saying that, you know, they need to consider other options, including a breakup, a sale of certain assets, and they say everything should be on the table. What is the company saying is on the table?
I mean, look, so that is something that media companies don't like doing. I think there's, you know, it's media. There's an emotional connection to a lot of the properties they have. And a lot of these properties, CNN, you know, they're historic names. But I think, look, management yesterday on that earnings call said all options are on the table with a suggestion that, you know, that is on the table. But, you know, other strategies to kind of spin this forward that they talked about were the, you know, the promise of international. I think, you know, anyone can talk that game, though, and it's tough trying to expand abroad. And they also talked about joint ventures, not just abroad, but also domestically. And let's remember that Warner Brothers and Disney do have that JV coming up, but there's an issue with these joint ventures, right? You lose control, you lose that revenue control, and also going forward, you lose that customer data exclusivity.
Charlie, wonderful to get an update from you, sir. Thank you. Charlie Wells there of Bloomberg. Out of London on the latest. The difference between what you hear from Warner Brothers and what you heard from Disney, just in a word, confidence. The confidence you heard from Disney in the streaming business, compare that to what we're seeing from Warner Brothers Discovery, night and day.
And you have the awkwardness that you mentioned, Anne-Marie, that you get these analysts coming out and saying you should break up your company that you only just put together 2 years ago. And I really think about this from an advertiser's point of view. Who would you rather give your ad spend to? Linear TV that has less viewers, or someone like Amazon who literally knows every single data point about their audience, and they can do incredibly targeted ad. They're losing this war on multiple fronts.
But that's the thing, it's these targeted ads, and streaming offers that. And if you look at some of the political spend we've already seen, top of the pile, especially for the Democrats, $111 million I saw yesterday going to streaming. So that's where the money is right now, but investors aren't there just yet. And also, it's a political season, and they're having to write down cable networks.
I know. Look, it's odd to talk about the news on the news, but ultimately, for that news organization, still struggling to work out what they want to be based on what you've seen in changes in the lineup and strategy. It seems to be all over the place still.
Changes in the lineup, also changes in editorial direction, and they really seem to struggle coming out of the Trump administration on who their audience is as well.
Many news organizations have. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Let's cross over to Yahira Hackers. Hey, Yahira.
Hi, John. Russia has declared a state of emergency in its western region as Ukraine's military launched what appeared to be its biggest incursion into Russian territory since the war began. President Vladimir Putin summoned his top security and defense advisors to brief him on the effort. Ukraine has targeted positions and energy assets well within Russian territory, and right now European natural gas is trading around the highest levels of the year as concerns spike over disruptions to Russian fuel crossing Ukraine. The summary of opinions from the Bank of Japan's July 31st meeting showing officials didn't see their rate hike as policy tightening. The comments suggesting they didn't expect the move to be big enough to disrupt global markets. This coming after the BOJ said yesterday it won't raise interest rates when financial markets are unstable. And Liberty Media, which owns Formula One, says an investigation has been opened by the Department of Justice over the decision to reject an application by Andretti Racing to enter the motor racing competition. Andretti's bid to become the 11th F1 team was rejected on the grounds the team couldn't be competitive with the rest of the field for at least another 2 years. But earlier this year, a group of U.S. senators cited concerns F1 may be acting at the behest of foreign automakers to exclude the team because of its partnership with GM. That's your Bloomberg Brief. John?
Yahira, thank you. I, for one, don't want extra teams on the grid. Just my opinion for whatever that's worth. Not the company's opinion, my opinion. Do you want extra teams on the grid?
I don't want extra teams. I don't want all of these races because I do nothing with my life now except watch F1. And when it's not on, I'm watching the Olympics.
So you'd like a tighter calendar?
Yes,
fewer
please.
Races, fewer teams?
I just want my Sundays back. That's all.
Are you complaining about someone else, or you actually like Formula One?
No, I like Formula One.
Okay,
Yeah,
good.
I
Just
do.
trying to work out if there's a problem in the Berger household.
No. It's mutual. We all like F1 in the household.
Good to know. As we count you down to jobless claims, 8:30 Eastern, the number we're looking for is 240. The previous week was 249. If you want to understand what is a good and a bad number, anything down in the low 200s is absolutely phenomenal on a historical basis. But we are looking at the change here, and we've started to gap higher on jobless claims, which is concerning, particularly when the likes of Bill Dudley, the former New York Fed president, start talking about this reinforcing mechanism that we may well have activated in this country. So numbers to look for a little bit later. A playbook, a guide, if you will, from Andrew Honhorst over at Citi. Initial claims remaining at these levels in August would confirm the slowdown, and a rise to 260 or above would signal deeper weakness. Citi and Andrew have said this a few times. 260 is what they're calling the so-called danger zone, just in terms of the direction of travel, the momentum and the pace of this move higher in claims. That number drops at 8:30 Eastern time. Up next on this program, the bond rally, losing momentum.
The challenge for bonds is there's, over 100 basis points of easing priced in for the rest of the year. And if you don't get that, total return performance in some of these short maturity fixed income securities will be challenging.
We'll continue that conversation next from New York City. You're watching Bloomberg Surveillance.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build. So it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
We're talking about the same thing. Jobless claims a little bit later on this morning, 8:30 Eastern Time. Neil Dutta Renmac wrote this. The unemployment rate has climbed for 5 of the last 6 months and is running 0.3 percentage points higher than the Fed's year-end SEP estimate. SEP, the summary of economic projections you get from the Federal Reserve, which will get an update in September. The ongoing slowing in inflation means that monetary policy was already too tight. Stop making this about the stock market. It isn't. In the view of Neil and so many other people, this Federal Reserve is offside. They need to correct interest rates. And for the likes of Bill Dudley, Bill thinks that's like 100 basis points offside. He thinks we need to see a big move here.
I think one of the problems is you listened to Powell last week, and he basically said, look, this is a stronger jobs market than it was before the pandemic. And you just take claims on its own, and it's really hard to make that argument. Claims before the pandemic running something like 211 on average. They're at 238. Claims are higher than they were before the pandemic. So I think you can look at that and say, clearly, when it comes to this labor market, the Fed is offsides.
Just slowly creeping higher, moving in the wrong direction. Let's check out the price action. Equity futures on the S&P just about positive by 1/10%. In the bond market, yields yesterday shifting higher off the back of a sloppy auction, just about unchanged on a 10-year now, 393.60. Under surveillance this morning, the bond rally losing momentum.
The challenge for bonds is there's, over 100 basis points of easing priced in for the rest of the year. And if you don't get that, total return performance in some of these short maturity fixed income securities will be challenging. We're probably not going to see a big repricing higher in yields. And I think it's probably more going to be, how weak does the data get? Can that drive even faster Fed expectations? But base cases, we've repriced yields, and we're probably just, I think, going to sit around these levels for a while.
So here's the latest. Treasury's holding steady. Traders spurning a sale of 10-year notes at lower yields and a sign that the recent bond market rally may be losing some momentum. Tony Rodriguez of Nuveen writing this. We expect the 10-year to end the year close to 4%. We believe we have seen peak curve inversion and expect the curve to remain close to flat moving forward until it steepens more in 2025. Tony joins us now for more. Tony, good to see you.
Good to be with
Two
you.
time frames there. So we've got going into year end, then we've got a different theme added to 25. Let's start near term. What are the forces going into year end, which basically leaves this bond market where it is at the moment?
So right now, we think the forces that leave the longer-term bond market where it is at the moment is that we have a slowing economy. So the Fed has moved from a single mandate, inflation fighting only, to now a more balanced mandate where the risk to the employment market is becoming front and center. We think that is going to shift to where that is the primary driver of Fed activity. So when we look at the long end of the market, we think that's already priced in quite a bit of that slowness, right? We were in the high 4s, we're now in the high 3s. We think 4 is kind of fair value. It's the funds rate that has not caught up yet to the market, and we think we'll certainly begin that process in September, but they're behind the curve in terms of where the funds rate is today.
Just help me understand something. On inflation, are you just acknowledging they're going to accept a higher inflation rate above target inflation, or do you just assume that inflation will come down as this economy decelerates?
We think that inflation will come down as it decelerates. It's going to be slow. If you look at where we are right now, core PCE 2.6 year over year, the 3-month annualized is at 2.3. So we're moving in the right direction. We think we'll end the year around this level, 2.6, 2.5. But by the time we get to the middle of next year, we'll be down into the 2.3, heading towards 2% early 2026, we'll call it. So it's going to be slow and gradual. But while that is happening, we think we slow down from a growth pace of what's been 2.5 to 3 down to more of a 1.5%. And that's when at that rate of growth, you're certainly more susceptible to any kind of exogenous shocks that might hit the economy, things like what we saw with just market volatility over the last week. So that's where we think the Fed's going to have to react a little more aggressively as we move through the next couple of quarters to get the funds rate in line with where we see longer term rates.
I want to ask about that volatility and where it leaves us specifically with credit. Because you've had this type of move that you haven't had for some time, that is widening. Take high yield spreads in the past 3 days blow out to 67, that is through Monday, and then they have coming up into today. Where does that leave us?
So we think that it leaves us today much closer to what we would call fair value. When we were sitting at 300 over in high yield, we were sitting at 90 over in investment grade credit. That was clearly pricing in quite a bit of good news. Solid credit fundamentals, continued growth, steady pace of maybe, rates coming down a bit. Right now, the move that we saw, while it was big, it was coming off a tight level. So it's not as worrisome in the sense that now we're getting closer to fair value. We call it fair around 350 in high yield. We've been kind of around basically a little above and below that recently. That seems like fair value. We think there's opportunity there. If you saw the high yield market widen from here, another 100 plus basis points, that would be reflecting a more material risk of hard landing than we think there is in the market today.
Well, just looking at what happened yesterday, I'd have to assume a lot of people agree with you with just this mountain of issuance we get from investment grade companies. Something like $30 billion, the most of this year. Meta has something like a $10.5 billion offering, and people hoover this thing up. People are happy to buy it. Is there some degree which companies aren't being tested, that the supply is such that people are really happy to absorb it, and some of the issues with some of these individual companies are getting papered over?
Well, when you look at the investment grade market, there is a lot of appetite there. And partly it's because credit fundamentals are solid, so we don't expect significant downgrades. We think that, whether you look at interest coverage, whether you look at debt to cash flow, those metrics, while they're a little weaker than at their best levels of the last 2 years, they're still in very solid territory. And you look at the yield that's available there, and you're getting 5.5 to 6.5%, that's a very attractive return for all kinds of asset class allocators in a very high quality, relatively low volatility asset. So supply's up 20% year over year, easily absorbed. If we saw that kind of 20, 25% year over year increase in dicier parts of the market, like really low quality credit, in this environment of economic slowing, that I think would be a little bit more difficult to digest. And obviously where the supply is greatest is in the Treasury market. That's really where the balance sheet is probably weakest as we look across consumers, corporations, and governments.
I want to ask about the wobbly auction yesterday. How much do you think in investors' mind that they're actually going to start thinking about, I don't want to sound like Lisa here, but the health of the U.S. trajectory when it comes to the fiscal deficit?
We think it's going to be at the earliest a kind of mid-2025 issue for the markets. The reason we had, I think, a sloppy market is because you had this huge run over the last week. So the actual value available at a, sub 4% type of yields is really not that attractive. So that clearly moves some demand to the side there. But at that fair value level of 4%, we think auction sizes as we see them through the balance of the year, those are going to be relatively digestible. We'll have some sloppy auctions, but generally I think they'll be pretty solid. But then looking into next year, because we're not going to do anything to address our fiscal deficits, that supply is going to continue to be large. That's when I think we're going to have maybe a little bit more possibility of auctions, not failed auctions by any stretch, but certainly ones that don't get digested easily.
So you think we maybe get a repeat of what we saw briefly in 2023, coming out of the summer, going into the back end of the year, I think through to the end of October?
Yeah.
When supply starts to matter a little bit more again and yields start to climb?
I do. I mean, we don't think it'll be a, British gilt market replay type of storyline.
A Liz Truss moment?
A Liz Truss moment, because there's just deeper pockets of demand for the U.S. asset. And as we see that slowing economy that we're expecting, clearly there'll continue to be a big flight to quality, bid to the Treasury market, and yields at 4% plus or minus are still pretty attractive from an absolute return and income perspective.
What's the dominant force then behind that 2025 steepener that you're looking for? What does that come from?
The Fed finally catching up to the market in terms of the front end.
You think it'll be that late?
I do. I think because the market right now in the front end, if you look at 2s, 3s, 5s, they've already priced in a lot of the Fed cuts. So flat curve at the end of the year had been our forecast as of the first quarter, with some modest steepening from there. But when we talk about steepening, I'm talking about a funds rate to a 2-year that might get eventually to 25 basis points, 2s, 10s, it might get eventually to 35 to 50. So
that's the shape of the curve. That's the difference between the two. Walk me through levels. Where are those individual things?
We think it's 4% across the board at the end of the year,
okay.
And then we think you can get down to like a 3.5 on the 2-year. That'd be a target level.
So you got like Fed funds at 325?
Exactly. Ultimately, we think that's the long run equilibrium level, which is why we think the Fed right now is pretty far behind. It's a very restrictive level right now when you look at the real yield of the Fed funds rate. So even if you took 100 basis points off of that today, you're still at a restrictive level, just not as restrictive, but probably more in line with what the current balance of risks is on the inflation side and the employment side.
Tony, this was awesome. It's great to get your thoughts. Thank you, sir.
Good to be with you.
Catch up. Thank you. Tony Rodriguez there of Nuveen. Just a programming note for you. In the next hour of Bloomberg Surveillance, as we count you down to jobless claims, 8:30 Eastern Time, here's the lineup for you. Samir Samana of Wells Fargo will speak to Bloomberg's Shelley Banjo, David Rosenberg of Rosenberg Research, and Matt Dezok of Merrill and Bank of America Private Bank. David Rosenberg thinks, like Bill Dudley, that process in the labor market, Danny, has already started. It's reinforcing. We're in that phase, in that cycle right now.
And the reason that's scary is because once it gets going, it doesn't move in a linear fashion. So if it's just starting, maybe we're already too late. And the next move is you get rid of companies hoarding and the unemployment rate shoots up much higher.
Big economic data point after the commercial break in about 34 minutes time. We'll be counting you down. Equity futures, the scores going into it, just about positive on the S&P 500. We'll see if these levels hold. In the bond market, yields a little bit lower, down a basis point. Your 10-year 393.21. And for those of you interested in dollar yen, there's many of you I know, dollar yen 146.22. We're negative on that currency pair by 1/3 of 1%. From New York, this is Bloomberg.
First of all, global trade, which had adverse consequences that we're learning about to this day, still unleashed an enormous amount of gain for humanity. And with the rise of global trade became the rise of information sharing around the world, which rapidly accelerated the trajectory of mankind. I mean, of note, the Chinese, for example, are leaders in solar. They're leaders in EVs. They're leaders in a number of emerging technologies. In a world which is more splintered, we'll see the gains that the Chinese have achieved in these important areas not shared by the Western countries. And conversely, the United States is a clear leader in AI, along with a number of the European countries. And those gains will not be shared with China and the countries in its sphere of influence. So it's a very clear-cut loss for all of humanity when we have the severing of ties between our countries.
On a practical level, is it getting harder to manage the risks you face?
I think that one has to be aware that there are more tail risks that are harder to ultimately manage.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Do you think it'll be the case where someday you will be an investment committee or I'll be an investment committee and we just apply AI, decide whether it's a good deal or not, or we're not going to be there anytime soon?
I don't think we'll be there in the near term. And David, because being on investment committees, there's the analytics of the math, there's the people, and then there's judgment. So analytics of the math, I think AI will help us get way more refined. Right now, we have analysts building models upon models. Our typical investment memo is 86 pages. So we could refine that down very, very seamlessly to pieces. The people aspect to it, to make a judgment call on, do I believe this entrepreneur is going to go the next mile? Do I believe that the background of the entrepreneur, who they are, what they stand for, their values, their family, that's the harder one. I think AI is going to take some time to get there. And then the final piece ends up being judgment. And I don't believe we've seen anything yet that gives us a sense of judgment that we're able to apply.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Time to start the cutting cycle, but we don't see evidence of a recession yet, and the soft landing is still in play here.
I don't think the data suggests that we're going to have a hard landing anytime soon.
These trends have been underway, they're persisting, and our fear is that the soft landing could be slipping away.
The bad news is no longer the good news. I think bad news is not bad news.
The Fed needs to regain control of the economy. Unless you establish anchors, the volatility itself of the marketplace will undermine economic well-being.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
I think enough of the talk now. We want to focus on the data. We've been starved of it. We get a little bit more in about 30 minutes' time. Equity futures going into it. Your scores just about positive on the S&P 500 by 0.1%. On the Nasdaq, up a little more than that. On the Russell, a little less. We're negative on the small caps by a little more than 0.1%. That's the equity market picture. Going into this, the economic data, jobless claims. In 29 minutes' time, the estimate 240, the previous number 249. We're near the highs of the year. That is not where we want to be. Danny Berger.
It's certainly not. So if we get another high report this time, does it break the trend even higher? Right now, 4-week average is 238. And you were talking about some of the figures coming from, the likes of Citi saying that 260 is something that's concerning. I think anything that makes us push above that 238 level is worrisome. But what happens if it's just seasonality and we read too much into it and then we get strong data next week?
Confirm or deny? This is a theme. Game, if you will, that we've been playing over the last couple of days or so. Last week we saw ISM manufacturing, clearly confirmed a slowdown. Saw jobless claims, the wrong kind of upside surprise, clearly confirmed a slowdown. Saw it in payrolls and the unemployment rate as well. Then we had the ISM services number. ISM services was better than expected. Didn't exactly put this story to bed. You need more of it. And this is something that Seema Shah, principal, was saying on the program a little bit later. You need economic data. You need to see it repeatedly come out better than expected. Just to kind of put this story to bed, you need to see better earnings as well and more dovish Fed speak. Are we going to see some more of that a little bit later this morning?
Well, what's interesting is that you need to see this as a trend, and it's hard to look at claims as a trend in the summer when there's so many moving parts when it comes to seasonal adjustments, schools are out, and also you have the weather and the hurricane. I'm interested about this range Danny's talking about because it was established in 2022. 200,000 to 260,000 is that range. So if we go above that, the market is going to freak out. But to your point, Jonathan, what is the market confirming? Because when services came in, it didn't really move that much. So basically what the market seems to want to confirm is bad news at the moment.
I've said this a million times. It's not just the United States looking at this data, it's the world, including Tokyo, Japan. So let's talk about what's happening in Tokyo, Japan. Dollar yen right now, shaping up as follows. We're at 146.27, that currency pair negative by about 1/4%. So no drama there at the moment. If you turn to the bond market, just a broader picture of things. Cross-asset, treasuries, just about unchanged. Yields going nowhere, 393. And going into this data later at the front end of the curve, the 2-year, just about unchanged as well. We're trading right now at about 397. Coming up this hour, Samir Samana of Wells Fargo on why it's time to buy the dip. David Rosenberg of Rosenberg Research on the growing slack in the labor market. And we'll catch up with Matt Dizok of Merrill and Bank of America Private Bank saying fixed income, it's doing its job. We begin with the big issue, the rebounded stocks failing to take hold ahead of another look at the US job market at 8:30 Eastern Time. Samir Samana of Wells Fargo with this to say. Broadly, risk assets will struggle to break out, given uncertainty around elections, geopolitics, and the economy. But this is a time to be accumulating the assets you want to own for the coming year or two. Samir's with us now for more. Samir, I've wanted to get your thoughts for a while because I know you've been less constructive over the last year or so. What is it about the last week or so that you think has opened some opportunities for people with a time horizon of, say, 1 to 2 years?
Yeah, so I think the first thing is the market reaction, right? The market finally woke up to the fact that more aggressive rate cuts will come with a weakening economy. I mean, I don't know why it's so shocked. We've been saying this for a long time, that the Fed just wasn't going to run out and cut rates in a solid economy because that unleashes inflation, which would undo all the work that they've done thus far. 2 would be valuations, right? The S&P has gone from almost 5,700. At one point, we were down to 5,100. On the Russell, 2K, we were at, almost 2,400. Now we're at 2,000. So I think valuations also help. The third is the Fed's, finally there. They probably will cut in, September. They probably will go 50 basis points. So it's also good that they now have the confidence they need to cut. So when you take all those things together and the fact that the economy probably bottoms sometime in the first part of next year and markets tend to run ahead of the economy, we think probably in the next few months, especially going into elections, there's going to be a really good buying opportunity. So we wanted to put that marker out there.
Just to demonstrate, just to validate your views on the market, do you need the Fed to validate what's currently priced for rate cuts?
I think the Fed is kind of a little bit behind the curve, so I don't need the Fed to validate our thinking. I think they'll eventually get to kind of where we're at, which is that the economy is probably on pretty solid footing, but that they do need to get, rate cuts underway. And they probably do need to be a little bit open-minded as to exactly where the rate needs to go. Our opinion is that they'll probably do about 100 basis points this year and 75 basis points next year. I think their forecast probably call for a little bit fewer than that right now, but I think they'll eventually probably revise some of those economic forecasts down and some of those rate cuts higher.
So you've got about 7 rate cuts priced in for this year and next. Samir, why don't you like fixed income at this moment?
So the tricky part with fixed income is the long end has come down so much that at this point, it probably just doesn't pay you to take kind of that duration risk. On the short end, unfortunately, because those rates will be coming down, there's also not a lot of places to go. What we actually ended up doing as part of these, kind of series of moves is we upgraded high yield, where we've been unfavorable for a couple of years now. We took that back to neutral. You still get kind of an all-in yield of around 7.5%. And, we think that's pretty attractive, especially if you're going to start to see easing financial conditions into the early part of next year.
So I get what you're saying on the front end of the curve. Essentially, it's already priced. It's gone as far as it can. But can I look at a day like Monday and say, even though it might not have been about the fundamentals, about what the Fed will actually do, we saw a rally because it provided me some support that when equities start to fall, at least bonds do the thing that bonds are supposed to do. Can you not buy it just as a sense of a hedge?
So we are neutral on duration, and I would say we still have, even now, pretty healthy allocations to fixed income. So it's not as if we're telling people to kind of avoid it altogether. But I guess if you look at large cap U.S. equities, they have a lot of the quality characteristics that we like. And I think going forward, if you're looking out a year or two, I think that's where the return will be. Now, to your point, in the near term, could you have maybe an even more extreme overreaction on kind of the long end of the curve? Could rates fall to 3.5? It's possible, but again, as an investment, looking out over the longer horizon, it's
upcoming ahead of the election as a buying opportunity. Why is that? Is that event driven?
So it really has to do with uncertainty, right? The market hates uncertainty. I know it's an old adage. I know it's a little bit tired, but really it does, right? And with the elections now basically being a toss-up, we think that maximum uncertainty will hit literally right before the elections. Might even happen after the elections if it's kind of a contested election. And what we want investors to do is when they look out, again, a year or two, we want them to take advantage of that, because what we've realized over time is the market can live with either administration. You may have different, sets of stocks kind of do well under one or the other, but overall, the market should do pretty well. And if that, uncertainty, if that kind of contest does lead to a bigger pullback, what we want people to focus on is the fact that corporate earnings are starting to turn around. Higher unemployment rates actually benefit corporations because they can be more selective about their hiring. Those are the things that we want investors to take away and focus on heading into that uncertainty.
To me, that's the path forward. Can we talk about the path for the next 30 minutes or so? I'd love your thoughts on jobless claims. We're looking for 240. The previous week was 249. What are you and the team looking for from this number today?
I would say if the number causes more volatility, I think you have probably, seen 70 to 80% of the drawdown for this leg lower. If there is a retest on that initial jobless claims number, we would be a buyer. Again, I think the story's been clear for some time. The economy's slowing. We've seen it on the lower rungs. We've heard the consumer-oriented companies talk about it. It would not shock me to see a higher than anticipated number. And if that leads to a sell-off, I would be a buyer.
Samir Samana of Wells Fargo. Samir, thank you, sir. A buyer of any weakness off the back of an upside surprise on jobless claims in 20 minutes' time. That's his playbook. The estimate right now, Danny, 240. The previous week, 249.
And there's been a lot of talk that 249, and you could see this in the data, right? It comes from Texas. It comes from Hurricane Beryl. It is temporary, and it rebounds. That's part of the reason why people are looking to this data point, to either confirm or deny some of what we saw. But it's a hard argument to make when we just got jobs data and the BLS comes out and says it's not weather impacted, and you get this whole host of people saying, hang on, it is. Are we just going to do that again today? That maybe we'll get something like 240 or even higher, and then you just get people saying, hang on, this is just seasonality.
Then once you get through this, it's on to next week. PPI, CPI, retail sales, as Danny indicated, over the next month or so. CPI report next Wednesday, August 23rd, Jackson Hole. That is a much anticipated speech from Chairman Powell when we get one. September 6th, the payrolls report. September 11th, the CPI report. September 18th. I know it's just around the corner, but I keep saying this. September 18th and that Fed decision, lifetime away, like lifetime away. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Delta Airlines has been hit by a class action lawsuit. The company is accused of failing to properly refund flyers or provide them with meal, hotel, and transportation vouchers after CrowdStrike's software outage last month caused widespread delays and cancellations for Delta. CrowdStrike is also facing lawsuits from consumers and investors over the outage. Taylor Swift's 3 shows in Austria this week were canceled after local police arrested 2 people on suspicion of planning a terrorist attack. A government spokesperson saying the decision was made by the event organizer. Officials found chemical substances at the home of a 19-year-old Austrian citizen and later detained another person in Vienna. Swift was scheduled to play the 3 shows starting Friday as part of her Eras tour. And the Olympics continue today with American Noah Lyles going for the double. After winning the 100-meter on Sunday, Lyles is looking to become the first U.S. man to win that race and the 200-meter in the same Olympics. That hasn't happened since Carl Lewis did it in 1984. On the basketball court, LeBron James and Team USA taking on Nikola Jokic's Team Serbia in the semifinals, and Team USA's women's water polo team's quest for a 4th consecutive gold medal continues in a semifinal against Australia. As for medal count, the U.S. continues to lead in gold and total medals. Behind them is China. That's your Bloomberg Brief. John?
Yahara, thank you. Shout out to Quincy Hull, 400 meters. You watched that yesterday?
I was really busy.
Amazing.
You know what was incredible? The steeplechase. I've never watched this event before. It's you have all these people on a track, jumping over hurdles, going into water. Guy, like, what? What is this sport?
That was mental yesterday. Quincy Hall looked gassed coming off the final turn and somehow came back to win a 400. Just phenomenal. Fantastic down the track yesterday for Team USA. Up next on the program, the Morning Calls Plus, Bloomberg's Shelley Banjo on Eli Lilly and fellow drug makers. Lilly in the pre-market up by almost 12%. From New York, this is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
"15 minutes away from economic data in the United States of America." We've said this a few times already this morning. There's so much emphasis on the jobless claims print because we don't have anything else. This is basically it for the week. Jobless claims and ISM services. ISM services earlier in the week, better than expected. Jobless claims this morning, the estimate in our survey, 240K. The previous week, 249. Talked a lot about the view over at Citigroup. Andrew Honhill's talking about the so-called danger zone at Citi. They say this: claims remaining at these levels in August would confirm the slowdown. A rise to 260 or above would signal deeper weakness. Let's see if we get that 260 or above and that deeper weakness. I can't imagine what this market looks like if we do get those kind of numbers a little bit later this morning. So they're the estimates for this morning. I want to go back to the month ahead or so, the next couple of weeks in this market, the path to September 18th and the next Fed decision. Next week's a big one. CPI, the highlight. You also get PPI and retail sales. Then it's on to Jackson Hole, Wyoming, the policy symposium for the Federal Reserve. A speech from Chairman Powell on that Friday, August 23rd, is going to be one to watch, I imagine. Then it's on to the payrolls report, September 6th. Let's see if that confirms or denies the weakness that we saw just last Friday. September 11th, another CPI report, and that's the last big one going into the Fed. So that's the month or so ahead of us in this market. It really starts again with jobless claims in just a moment. Let's take a snapshot of the market for you and look at futures at the moment. Equity futures on the S&P 500 just about positive by 0.1%. In the bond market, sloppy bond auction on a 10-year yesterday. Yields are a little bit lower this morning, 392.45. I can tell you a little bit later this afternoon at 1 p.m. Eastern Time, we get $25 billion of 30-year bonds. All of a sudden, Danny, we're talking like Lisa. We're focused on supply every afternoon.
Is this why Lisa's off? Because she knew if she would be on, this is all we'd be talking about?
She wanted a break from it, I think.
Yeah, I think so. She chose her timing well. It's funny to contrast that with what's happening in the corporate bond market. I mean, there's this huge issuance yesterday, the most of the year, and people just absorb that thing. And then you contrast that with the bond market that as soon as yields go below 4%, we decide we don't want to buy duration anymore.
Bramo texted me yesterday. She's having a great time. I'm not going to do a TK and tell you where she is. A European island somewhere. Sent me pictures. She's having a wonderful time. She's going to be back with us on Monday. That's the latest on the price action and Bramo's whereabouts. It's time now for the morning calls. First up, Bank of America lowering its price target on Disney to 120 from 145. The firm keeping a buy rating on the stock, but pointing to slowing demand for the company's theme parks. That name's down another 0.9%. I still struggle with the explanation that we got, Danny, yesterday from the C-suite. The CFO saying low-income households are pulling back, high-income households are elsewhere, but the business bounces back by the middle of 25.
And what I also can't understand is if the business bouncing back is a bad thing for the overall economy, because it's his assumption that middle incomes start to hurt, so they don't want to go on the trips abroad, so they stay more local, and then they go to the theme parks. If that's the calculation, Disney doing better could actually be bad.
That stock is down by about 0.8%. Let's turn to another call for you. This from Citi, downgrading Bumble to neutral from buy and lowering its price target to $6. The firm citing the company's disappointing outlook and lack of turnaround guidance. That name, that is not a typo. We're down 40% in early trading. And your third and final call from Berenberg, lowering its price target on Merck to 135 from 143. The firm keeping a buy rating on the stock, citing surprise disruptions for the company's HPV vaccine sales. Elsewhere, fellow drug maker Eli Lilly gaining in the pre-market thanks to sales of weight loss therapy Zepbound. Bloomberg's Shelley Banto joins us now for more. Shelley, great to see you. That stock is up by more than 12%. Walk us through what's working over at Lilly.
I think this is sort of a moment in time to say that Eli Lilly might be pulling ahead of this race with Novo to get these weight loss drugs out there. Novo was first, but not necessarily sort of a lesson that like you can be first, but not necessarily best. You can be second and come from behind, and that seems to be the case, at least for right now.
What's behind the better execution? Why are they able to supply this in a way that the other side can't?
So both of them are facing supply issues, but Eli Lilly is starting to see those supply issues ease a little bit. And we actually had a scoop last week from Dave Ricks, the CEO, saying, we think we are going to come off of shortage pretty soon. And what that means is that could change the game entirely, get them even more customers, and also reduce the amount of these compounding drugs, these sort of knockoff drugs that are not generic but not brand either, and get more people onto those branded drugs.
Can I ask you about those? Because this I find so strange. All you have to do is watch some commercials or look online. You see people advertising for not Eli Lilly's drugs, not Novo Nordisk, something else that's weird. What's going on here? I mean, is there not regulation? Are people not in danger of using these not exactly weight loss drugs, but marketed as such?
Yeah, so the FDA does not regulate this corner of the market, and it is regulated by state pharmacy boards, and so there is a sort of oversight of these. It's perfectly legal at the moment, because as long as these branded drugs are in shortage, then these compounding pharmacies can make these. And compounding pharmacies are not anything new. They've been around. Actually, that's the way things used to be. Pharmacists would mix, little drugs and put them together. But the thing is, you just don't know as a consumer what exactly you're going to get, and the regulation is just not as high there.
So to your point, maybe it's a healthy thing for the overall market if Eli Lilly can pull ahead and get some of its supply out there. How much does it change the game if Roche comes out with a pill?
Well, that is the big game changer, is that it's not just Roche, it's everybody is trying to get into this game, and as we've seen with Lilly and Novo, it doesn't necessarily matter if you're first, as long as you have a product that people want to buy, especially with the market being so big, and as more people get accustomed to everyone that they know being on these drugs, it becomes more regular, and the market keeps growing bigger.
When you look at the generics market, there's a huge push in Washington to get these companies to allow generics. When can we see that?
I mean, I think we still have a little bit of time here. I mean, Bernie Sanders has been going really hard, in particular on Novo. They want to bring these prices down. One thing that's interesting about Lilly's drugs is that they are actually cheaper than Novo. It's about $1,000 a month instead of $1,300 a month. And so these are starting to get cheaper, but they are weighing on health plans, not just company health plans. All these folks are really starting to see the bite of what insurance coverage is on these things. And so what Bernie Sanders and others have said is, why can I get this same drug so much cheaper in Europe than I can in the U.S.?
John brought this up yesterday. Is it a drug or is it a treatment? Because I imagine to get those insurance benefits, it has to be for a drug.
So and that's sort of what we're seeing now, is that we had this really wonderful story out. I encourage everyone to read it, about a town in Bowling Green, Kentucky that has the highest percentage of people on these prescription drugs. And one thing that our reporters, Madison Muller and Devin Leonard, found were people who said, I was taking these medications, and then my weight loss, worked. My weight dropped, my blood sugar, all these things, got under control, and then I lost my insurance coverage. And so it's like, well, and then if I want to keep going on these drugs to keep all that stuff in check, I'm going to need to be able to pay for it somehow. And then that enters the compounding market, where people are then shifting to some of these other kinds of drugs. And so it's a little bit of a mess.
Has the opportunity to revolutionize this economy, given obesity rates of what, close to 40% in the United States?
It is a huge addressable market, and then you get all these kind of side effects. It's like, are gyms going to be more popular or less popular because people have lost weight?
Good point.
All of a sudden, are we all buying Lululemon because we're happy about our bodies and feel good about how we look? Is Krispy Kreme going to all of a sudden go bankrupt because people aren't buying donuts? I mean, it has really wide-reaching repercussions.
Shelley, it's good to see you. Great story, by the way. Shelley Banjo there of Bloomberg on the latest, with Eli Lilly up in a pre-market by more than 10%, up by 12.5 right now. Jobless claims are just around the corner. Mike McKee's dropped by to get you all up to speed on that. Mike, walk us through what we need to look for in about 7 minutes' time.
Well, a couple of things we need to look for. One is obviously the level of initial jobless claims and whether it goes up or down. It would be no surprise if it went up, because seasonal factors push up jobless claims at this time of year. This may be the last week in which that happens. So we also want to look at the non-seasonally adjusted claims, because those would have to rise if we were getting a lot of layoffs. So it may be a seasonal adjustment problem. It may be the economy and labor market weakening problem. We just don't know. And we also want to see what the jobless claims numbers are from states like Texas and see if the hurricanes are starting to, so to speak, wash out of the claims numbers.
Mike, is that enough, doing all that legwork to wash out all of the noise and get a clear signal? Or should we approach this kind of tepidly to say that it will have seasonality oddities and don't read too much into it?
Well, you're right, Danny. That's the way we should approach it, but will Wall Street approach it that way? That's the question. I mean, you have people essentially looking for reasons to sell on the idea of economic weakness. And so if we get any kind of significant rise in jobless claims, you'll probably see a negative reaction to what's going on. Now, Ian Lingan of BMO, you had him on yesterday, he's talking this morning about how we haven't seen rates really move since the Fed meeting, since right before the Fed meeting. We had some volatility between then and now, but we're about where we were. So markets have already priced in weakness. The question is, do they sell even more and price in more and push yields up?
Mike McKee, thank you, sir. Looking forward to catching up with Mike in just a moment. That number drops in about 6 minutes' time, 5 minutes away. Jobless claims. Mike's going to break it down for you. Then on the program, we'll be catching up with David Rosenberg of Rosenberg Research and Matt Dezok of Maryland Bank of America Private Bank. Danny, to Mike McKee's point, how the market responds to this data point might be very different to how Federal Reserve officials respond to this data point, because what we saw on Friday was a market get very, very spooked by payrolls, and what we've heard so far over the last few days from Fed officials, they don't sound spooked at all.
That's why I'm so looking forward to when Barkin speaks today, because among all of them, he's been very nonchalant. Last time he spoke, Friday after the jobs numbers, he said, well, if we had have hiked, there probably would be people out there who still would have criticized us. We can't win either way, so we're just going to do us.
I thought they were blessed with criticism. I thought that's what Chairman Powell said. I thought we blessed them.
I think Barkin might disagree on
didn't see it
on
the
that
same
point.
way.
Yeah.
I don't think Chairman Powell sees it that way either. 240 is the estimate in our survey for jobless claims, 249 the previous week. The number up next.
always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Have we ever talked about jobless claims this much? It feels like in some places in the world of economics, jobless claims today are being treated like payrolls. A lot of weight being put on this number. It drops in about 15 seconds' time. The estimate is 240. The previous number is 249. Mike will breathe some life into the conversation on continuing claims as well. That number drops in just a moment. The score's going into it. Equity futures just about positive on the S&P 500, just about positive likewise on the NASDAQ. With economic data, here's Mike McKee. Good morning, Mike.
Well, we have some good news, or I don't know what counts as good news these days. 233 is the number, 233,000 initial jobless claims, significantly lower than the 240 estimated and the 247 that was the whisper number. So we are retreating back a little bit, and that is not unexpected. I mentioned earlier we have seasonal adjustment effects in the month of July, and that seems to be what's happening. Continuing claims, 1,875,000. That is down from the previously reported 1,877. By the way, the previously reported initial jobless claims for last week revised up to 250,001, so it makes the drop a little bit more, 17,000. But it is a drop in that number. Now, I'm waiting for my numbers to come up for the non-seasonally adjusted. It takes a while these days with the internet, and I'll bring that to you in just a second.
You wait for that, Mike. I'll go across to the equity market. This is how much weight the equity market was putting on this jobless claims number. We're up by 0.6%. I don't know if this move sticks, but it just gives you an idea of how much weight some market participants were putting on this number this morning. The NASDAQ 100 up by 0.8, the Russell up by 1.4. We'll see if these moves hold. Yesterday, they did not. We'll see if they hold throughout this morning and into the afternoon. In the bond market, treasuries lower, yields higher. We're up by 5 basis points on a 2-year. We're back through 4%. On a 10-year, we're up by 3, getting closer and closer to 4% all over again. And if you're in Tokyo, Japan, at the Ministry of Finance, or the BOJ, and you're watching, good afternoon to you. 146.80 is where dollar yen is, just about positive now on the session. So, Danny, there it is in jobless claims. We like to say that is the right kind of downside surprise.
This market was a coiled up spring waiting for that. The biggest of the springs, I think, just going through the board, is Russell 2000. And that's a really fascinating one because we used to argue that the coming of cuts would be great for the Russell 2000. Here we go, something that has knocked off the idea that cuts are imminent, are in a big way, and yet we are rallying.
Just a little bit of a relief rally in the equity market, a little bit of a sell-off in the bond market, and a bit of a stronger dollar off the back of this as well. Mike McKee, you've had an extra minute or so. What do you see in the data?
Well, let's take a look at the non-seasonally adjusted numbers. They come in at 203,000. And that was 215 the week before. So a significant change there as well, down almost 14,000. The seasonal factors had anticipated not much of a decline, and so we get a much bigger decline than anticipated there. And then when you look at the largest increases in claims, they were in Michigan and Missouri, about 4,000 each. Texas dropped by almost 7,000. So the big filings that we had after the hurricane washing out of the data, and that may be one reason. And when you look at the non-seasonally adjusted numbers, and even compared to the seasonally adjusted numbers, it tells you that while we're a little elevated over where we were a couple of weeks ago, it's not layoffs.
Yeah, I will say this, Mike. It does feel like we're firmly shifted into a good news is good news, bad news is bad news regime in this market, right?
Yeah, we have, which I guess is a good thing. But on the other side of the coin is that the bad news has been bad news for this market, too. I'm just really struck by comparing at this very moment to the narrative on Monday. The narrative on Monday was literally we are heading into a recession. The Fed needs to do an inter-meeting emergency cut Imagine if the Fed started talking like that, and then we got this number. I mean, if anything, you could say, all right, well done, Daly, well done, Goolsbee, for staying so calm.
Last week, the data, not great. ISM manufacturing, jobless claims, payrolls. This week, the data a little bit better. ISM services and jobless claims this morning. To look at the totality of the data, joining us now is David Rosenberg of Rosenberg Research. David, we've been looking forward to catching up with you, sir. Let's just take a step back. Totality of the data, as the Fed would like to say. What's your assessment of where we are, David, at the moment?
Well, I still think that we're either in a recession or about to confront one. And, you know, I know everybody's on tenterhooks because of weekly jobless claims numbers, which can quite often contain quite a bit of noise. And coming off what could have been hurricane distortion from the previous week. However, I would say that what's tried, tested, and true is the unemployment rate. And the unemployment rate is up 0.9 percentage points over the past 15 months. And the data going back to 1948 show that we had 12 recessions. And when you're up 90 basis points or more in the unemployment rate from the cycle low, you go into recession 100% of the time. So I am definitely not one of those people that would say to you, it's different this time. I don't think that it is. And today's jobless claims numbers, we'll get a fresh batch a week today. Doesn't change my view.
David, I'm going to push you on this, and I'm sure it's something that you have heard multiple times. So I'll give you the opportunity to tell me why I am wrong. The argument of you being wrong goes something like this, that the uptrend is about immigration. Torsten Slok of Apollo out with a note just moments ago saying that more visas are getting accepted, that there's been a COVID backlog, and that just adds again to the evidence that there's growth in the labor supply, hence the uptrend in unemployment. Why is that argument not right?
Well, the argument is partially right, but the reality is, just to go back, the unemployment rate comes from the household survey, not the payroll survey. But the reality is that there's been no growth in job creation in the household survey over the past 12 months. What the data show is that 96% of those people, and I'm sure a lot of them are immigrants, 96% of the people that entered the labor force in the past year have not found a job. Now, I would pose the question back to you. Does that sound like a buoyant labor market as far as you're concerned? This time last year, 96% of labor force entrants were finding a job. Only 4% now are finding a job. So it's not just about labor supply, and it's not just about firings or layoffs, which remain very low. Companies are still hoarding labor, but what are they doing? They're cutting the work week, and they're furloughing workers from full-time to part-time. Well, you get from full-time to part-time, it's not a job loss, so you don't collect an unemployment insurance check. But there are decisive shifts taking place in the labor market right now. So there's been no growth in household employment. And in fact, if you look at the full-time picture, full-time jobs are down on a year-over-year basis. The number of full-time jobs are negative year on year. And that does not happen typically in an economy that's still expanding. That's my point.
We heard from Mary Daly recently, and she said firms are not laying off people, to your point there. So why isn't this just normalization? How can we be a recession if firms are not laying off individuals?
Well, because employment is not just one number. It's the product of two numbers, firings and hirings. And what's happening, and it's not contained in today's jobless claim number, but you do see it in the JOLTS data, and you see it in the Challenger data, which is that hiring activity is collapsing. Like, I don't know what I'm missing. We just got a few weeks ago the JOLTS data. The JOLTS data showed that the number of new hires in the economy, the number of new hires is running negative 9% year over year. And the level of hirings is back to where it was in April 2020. So what's happening is that, yes, the firing rate is remaining very low for the reasons I said before. And a lot of it is because companies have this horrible memory that is lingering about letting people go in 2020 and then not finding them again. So they're holding on to their staff, they're cutting hours, repositioning staff to part-time from full-time, and that's giving this illusion that, yes, firings are very low. But what's happening is that the hiring rate is collapsing. We got the Challenger numbers just ahead of non-farm last week. So in July, the number of hiring announcements in the Challenger data was the weakest for any July back to when the data started in 2004. The number of hires in the Challenger survey is negative 71% year over year. So you're just looking at one side of the ledger, which is firings. But the reason why employment growth is decelerating sharply, even in the payroll survey, is because hiring activity is collapsing even as the firing rate remains very low. That's the story beneath the story.
David, as you know, where there is consensus right now, a lot of people believe the Fed needs to get less restrictive. There's another element to this as well. I just wonder whether you think they need to get accommodative. And when we talk less about the path and whether they go 25 or 50 in September and talk more about the destination, where do you think they're going to end up here at the Federal Reserve?
Well, you know, I think that Jay Powell gave us a ton of information at the podium last week at the press conference when he uttered the word normalization to describe the labor market and the economy no fewer than 11 times. Normalization. So things have normalized. You strip out the nonsense around owner's equivalent rent and the lag nature of the actual rents, and inflation is basically back to target. And the unemployment rate is actually higher now than it was before COVID, when the funds rate was 1.75. So he uttered the word normalization. The only thing that's not normalized is the Fed funds rate. And so what's normalized? Well, according to their own estimates, the neutral rate, the equilibrium rate, the rate that we should have in a balanced economy, which he said we're in, is 2.75. And every Taylor rule estimate shows that today the funds rate maximum should be 4%. We're still 5.25, 5.5. So they are ridiculously behind the curve. No matter what's happening with the equity market, and it wasn't about data that caused the markets to start thinking they're going to go intermeeting. It was, are we going to continue to get 1,000-point down days in the Dow? That was just all about the stock market. But they are ridiculously behind the curve, irrespective of what the capital markets are doing. So he basically said things are normalized, and we do not have a funds rate that is consistent with a normalized economy. So they have a long road to hoe.
David Rosenberg of Rosenberg Research. David, great to catch up, sir, to get your thoughts on this economy and where David thinks the Fed needs to be. You mentioned capital markets. We'll talk about capital markets. Equity futures right now on the S&P 500 near session highs up by 0.8%. Check out this move on a Russell, the small caps up by 1.6%. If you're just joining us, we were basically unchanged on the S&P 500 as of about 12 minutes ago before we got this economic data. Jobless claims delivered the right kind of downside surprise. 233 against an estimate of 240. It's not a big swing, and yet we are seeing this massive move in the equity market and bonds as well, Danny. Yields are up by 6 basis points across the front end of the curve, the 2-year back through 4%.
The thing that I'm really struck by is that this is a market trading this as if it was non-farm payrolls, like as if it was a North Star type of report, and this it is not. Not even just that. Not even that just historically this is a noisy print, but this one specifically is a really noisy print because of things like weather, because of the things of seasonality. We've put so much importance on this report, and that's why you got the market reaction you did.
Matt Diesel with us around the table of Merrill and Bank of America Private Bank. Matt, to Danny's point, we've both been talking about it. Are we going to treat every single jobless claims print every single week for the rest of this summer, the rest of this year, this way?
It's going to be exciting. We're going to be watching for it. It's going to be.
Do you think we should put this much weight on this print?
Yes, because then people want to talk to us about it. So I think we should. We absolutely should. And to your point, it's a very noisy number week to week. You got to look at the trend. But more importantly, at the start of a recession, generally speaking, weekly unemployment claims are sort of 350 to 450,000. So we're still well off the number where we see companies firing and people are getting really concerned about their financial condition. So we're not overly concerned about a recession right now. We're not calling for a recession. Certainly, the market implied recession odds were way too low a couple of weeks ago, and they're more getting to a place that's more normal. There's a higher risk of recession than zero, but it's still not a base case for us yet.
So what do you make of the levels we're at right now in the bond market?
So for the bond market, as you know, bond guys like undertakers, we're only happy when everyone else is sad. We've been listening for a year now, all these reasons why bonds don't work, why diversification isn't going to work, why you should have commodities, you have something else in your portfolio. Last week was close the blue book, put your pencils down, the exam's over. Bonds did their job. We've been saying this for a year. We've been counseling, getting long duration for over a year now, with real rates around that 2% level. We're below that now. They can do a job of diversifying. Back in 2021, when they were negative 2% real, right, when they were 50 basis points to 1% in 10 years, yes, they weren't doing their job. Now they can do their job. That was the most important thing we learned from the market, that when there is an economic downturn, when there is real market volatility, treasuries, high-quality fixed income collateral will protect your portfolio.
I look at the past week, though, and I say, yeah, they did their job, but in an extremely volatile way. That you saw some big swings in this bond market. Does that dampen their ability to give you protection? That if I have bonds in my portfolio, that it could actually add to some of the volatility in it?
That's a very good question. So Mark Cabana, our head of rates research at Bank of America Merrill, he does have concern about liquidity in the Treasury market. You can flip that a little bit on its head, though. There's no constitutionally guaranteed right to be able to trade a yard at 10 years in a millisecond. So when people realize that maybe the liquidity is not quite there, right, maybe they can't take as large positions, maybe there will be an increase in risk premiums in the market. For our clients who are liquidity providers, who are looking for money to work, higher risk premiums, potentially because of the bid-ask factors and liquidity you're talking about, is probably better for overall for investors on the whole, because that should lead to a higher term premium, should lead to higher credit spreads on average. They should get a little more compensation for that lack of liquidity. So we are a little bit concerned about it, but from an investor who's providing liquidity to the market, it can actually be a benefit.
Just to that point, do you think this week would have played out differently if it wasn't the dead of summer? If it wasn't August, if this was a couple months ago and all of this was happening?
I definitely think that was a factor. A lot of traders on their 2-week vacations now. August is a new September, it feels like. Definitely there was more volatility than we would have expected. And again, you start to see things in the market like 6 or 7 Fed rate cuts by January seem to overestimate economic weakness. It was more market technical sentiment driven.
So what do you do in a day like today when the markets are basically reacting to this claims like it's a non-farm payrolls because it's illiquid? It's August.
So one of the best things to do is just have your strategic plan in place and take opportunities like this as they give it to you. So we've been saying for a while that, again, we didn't expect a recession, but as we looked across the credit complex, we thought IG, high yield, even munis were a little bit expensive, so we were slightly underweight some of the credit sectors. But we haven't moved to an underweight position on equity. So actually, when we see volatility like this, we've been advising clients to take advantage of it, get back to their strategic targets, put a little bit of money to work. You kind of want this volatility. You want these drawdowns every once in a while to be able to add back to your portfolio.
When you get backups in yields like the ones we've got right now, do you think these are going to get bought? Do you think the last week was a wake-up call for the lazy money, if we can call it that, sitting in money market funds, getting rewarded for doing nothing, and they've been told repeatedly by individual after individual on Wall Street to lock in this yield, this reinvestment risk? That's like been the phrase of this year. Yeah. And then they've sat there and said, I don't know what you're talking about. You've been saying this for 12 months and we've had no rate cuts. Do you think this was the week where that money woke up a little bit?
I would like to think that's the case, but that's not going to be the case in my opinion. As you said, we've been counseling for a year or so that fixed income's longer dated bonds. Cash is not fixed income, it's variable income. You just don't know how long you're going to get that cash yield for. It's going to come down, but unfortunately what it seems like, until the Fed actually cuts, people don't actually move out of money market funds. So we're still going to counsel that. I do think this is somewhat of a wake-up call again, that if you were concerned that bonds couldn't diversify, I think that is taken off the table now. So that will hopefully encourage clients to get back to their strategic targets at fixed income.
Did you just give us a little sneak peek of what client conversations were like this week?
Yes.
Are they still reluctant to do this?
They've been reluctant to do this for some time, which is one of the reasons you know it's the right thing to do. When it's that hard to get people to do it, you know that's probably the right move.
Why do you think this week wasn't enough for them? What did they say back to you? What did those conversations sound like?
So essentially, there's always some new concern why they wouldn't want to move it to cash, whether it's higher deficits, whether it's the fact that they can still get 5.25%, even if they cut 3 or 4 times, they can still get it. It's very difficult to make the conversation. I try to tell folks, the yield curve tries to trick you. Right? When yields are that high in the short end and lower in the long end, it's trying to trick you, sort of don't fall for it. And again, we don't need to be crazy long bonds, but getting clients from a 2 to 3 year average duration to a 5 or 6 year duration is going to be better for them long term.
It's a big challenge still at the moment. Matt, it's good to see you. Thank you, sir. Matt Diesel there of Merrill and Bank of America Private Bank on the latest jobless claims print. Jobless claims Thursday is the new payrolls Friday, I guess, Mike McKee. Is that what we're going with now?
Well, at least for the time being, because it is August. Matt was talking about all the traders being on vacation. Everybody from the Fed's on vacation, too.
True.
And it doesn't give you any guidance, but I don't imagine anybody wants them to come back.
Light on data, light on speeches. Yeah, I think we'll all take that break. Mike, thank you. 233 is the jobs number, the jobless claims number, 233. The estimate was 240. So that's the right kind of downside surprise for you on jobless claims. The reaction, let's go through the boards and start with equity futures, roll through the bond market. Equity futures right now up by 0.8% on the S&P 500. Big outperformance on the small caps. That outperformance on the small caps encouraged by what's developing in the bond market. Check out fixed income. Treasury's a little softer, yields a bit higher. Up on the front end now by 8 basis points on a 2-year to north of 4%, 4.04 on a 10-year, up by 5 to just short of 4%. With an update on stories elsewhere this morning with your Bloomberg Brief, here's Yahara Hekes. Hey, Yahara.
Hi, John. Shares of Warner Brothers are down in the pre-market. The parent of CNN and TNT posted a second quarter charge of more than $9 billion after writing down the value of its traditional TV networks. The write-down reflects the continued exodus of viewers from cable networks like CNN to new streaming platforms. On that note, Warner Brothers said it added 3.6 million new streaming subscribers, almost double what Wall Street had estimated. Also down, shares of Bumble are plunging nearly 40% in the pre-market. The dating company reported second quarter revenue that missed estimates and slashing its revenue outlook for the year. In contrast, Match, which owns Bumble's biggest rival Tinder, jumped the most in nearly 2 years last week after the company delivered better than expected quarterly results. Eli shares are up nearly 13% in the pre-market after the pharma company boosted its revenue guidance for the full year. It's now projected to come in well above the average analyst estimate. The increases were primarily driven by strong performances of diabetes medications Mounjaro and Zepbound. The company plans to launch single-dose vials for Zepbound in the coming weeks. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate this morning. Thank you very much. Up next on the program, setting you up for the day ahead. Your trading diary just around the corner. From New York, this is Bloomberg TV.
The top names in tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as moniker, but it's not the same intelligence that I have.
Especially I'm afraid of whenever it's some kind of AI is speaking for me. I want to be myself, and I want to be the one speaking. I have AI myself. Yeah. Actual intelligence.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven computing, it's now intention-driven computing.
There's been a lot of us who've been working in AI for a long time. It's great now to see other people using it and seeing what some of the challenges are.
To stay ahead in tech, it has to be much more than just software. So you need long-term investments in science and research.
You have an ecosystem of companies coming together. It's causing a new industrial revolution.
Nobody covers technology like Bloomberg. Context changes everything. A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Counting it down to the opening bell, about 37 minutes away. Your scores, they improve. On the S&P, up by 0.8%. In the bond market, treasuries weaken, they soften, they cheapen. Yields are higher by 5 basis points on a 10-year, just short of 4% at 3.99. As jobless claims come in better than expected, it's the right kind of downside surprise at 233,000. The estimate was 240. Your trading diary, the day ahead looks like this. 1 p.m., the Treasury auctioning $25 billion in 30-year bonds. 2 p.m., former President Donald Trump holding a news conference from Mar-a-Lago at 3 p.m. this afternoon. We'll hear from Richmond Fed President Tom Barkin. On Friday, Vice President Kamala Harris making a campaign stop in Arizona. Trump holding a rally in Montana. Just a little bit of pressure starting to build in the last 24 hours. I think we all want to hear from Kamala Harris.
Yeah, we do, and not just when it comes to these set pieces like a campaign rally where she's off prompter. We actually want to hear what their policy proposals are going to be. How much is she going to differentiate herself from Biden? Because we do know that in the polls for the past year, it wasn't just Biden's age, but the top 2 issues when it comes to this election is the economy and is immigration. And when you ask voters, they say that it was better under Trump.
The top issue right now for this market, jobless claims, 233K. I'm pleased we're on the same page because this has felt bizarre, odd even. For the rest of this summer, I think going into the Federal Reserve decision on September 18th, it feels like jobless claims every Thursday is becoming as important as payrolls on Fridays.
We are trading it as such to the point where you can get a rally of more than 1% in small caps after jobless claims. Again, it really boggles your mind. Maybe you can say, okay, it's the summer, there's not a lot of people around, but it does just emphasize the fact that we kind of don't know where we are. There are people who have a very clear idea, and often they're on opposing sides. And when you get this trend shift, usually you have these periods of instability until you can establish a new trend. Does jobless claims establish that trend? Probably not, let's be honest. Maybe next week can go some ways to it, but again, it's choppiness until we find it.
Keep going back to that speech in Jackson Hole, Wyoming of last August, a year ago, with Chairman Powell, and he talked about navigating the stars under cloudy skies. Feels like that over the last week or so. ISM manufacturing was weak, jobless claims was bad, payrolls was not good. That was last week. This week, ISM services was decent, jobless claims were better. And to your point, this market is just stuck between the two, just getting whipsawed from one data point to the next.
I really like what Dan Greenhouse says, this idea that it takes months and months for a recession to happen. But along the road to there, you do get these signs of things changing. You do get slight changes of companies saying different things, individual data points coming in. And I think that's why you can build the argument that something is starting to happen. Maybe we're not there, but nerves are kicking in.
That start of that beginning of that self-reinforcing process that Bill Dudley was talking about. A lot of views out there, more views coming tomorrow. Steve Major of HSBC will catch up with Congressman French Hill of Arkansas, Megan Swiber of Bank of America, and Binky Chada of Deutsche Bank. The opening bout 34 minutes away. Good luck with the rest of today's session. From New York City, this was Bloomberg Surveillance.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
What about quantum computing? People talk about that. Is that something that I should be looking at investing in?
I've made a lot of mistakes, betting on these new technologies like AR, VR turns out to be not so big, 3D printing turns out to be not so big. My estimate is $100 trillion was invested in today's dollar in the PC, CPU-based infrastructure. All this is going to get ripped out to put $100 trillion or more in our GPU-based infrastructure. In that sort of quantum of numbers, I feel that the quantum computing is going to be very small.
You always are worried about, I presume, geopolitical events. So are there some geopolitical events you're worried about right now?
Yes. I don't know why, but for some reason, I love thinking about black swans. And at the office, everybody thinks I'm weird because I'm always thinking about what can go wrong. But underpinning the AI is the chips. And the chips, despite the CHIP Act, which I think was a good idea for the US, I still think like 80% or so of the capex of TSM is in Taiwan. And so at the leading edge, a lot of capacity is in one very small area. forget that it's just in China, it's in a very small area. I think that's very risky.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in. We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
The labor market gooses futures 30 minutes until the start of trading. I'm Matt Miller.
And I'm Shonali Bassett. Katie Greifeld is off today, and Bloomberg Open Interest starts right now.
Coming up, U.S. jobless claims declined by the most in nearly a year, helping to ease fears about a more pronounced economic slowdown. But J.P. Morgan now sees a 35% chance the economy enters a recession this year. The firm also says 3/4 of the global carry trade has now been unwound. And plenty of news on the corporate front. Weight loss drug Zepbound boosts Eli Lilly's outlook, while Warner Brothers drops on a $9 billion impairment charge. Let's take a look at where the markets are trading. Right now you see futures higher. They had been lower until we got this initial jobless claims number. A little bit lighter than expected, and that's enough to send us off to the races on futures. Remember, yesterday we had a really a positive open, and we were trading in the green for most of the day until we turned lower at the end. The NASDAQ futures are up more than 1% right now, and the 10-year yield climbs along with the rest of the curve. I think the 2-year yield was up to almost 4.1%. Shonali?
Yeah, it is, and it looks like the 10-years are about to be along with it. But let's take a look at some of the shares moving that you were talking about. Eli Lilly really jumping here. The company raised its 2024 sales outlook for the second time this year due to its obesity drug, and you do have Eli Lilly now up pre-market more than 12%. Warner Brothers Discovery is another story, reporting a second quarter charge of $9.1 billion, writing down the value of its traditional TV networks. A tough pill to swallow after that mega deal made years ago. Now Warner Brothers down more than 10% after reporting results. Flip up the board, let's look at restaurant brands. Sales grew less than anticipated in another hit to the consumer. The stock only down about 1%. Robinhood soaring now about 6.4%. It's been gaining some steam pre-market. Net revenue beat expectations, coming in with record revenue and EPS. Tune in to interviews with both of these CEOs. Robinhood's Vlad Tenev at 10:30 a.m., as well as the CEO of Restaurant Brands, Josh Kobza, at 10 a.m. Matt.
Yeah, very much looking forward to those CEO interviews. Right now, let's talk about the economy. Initial jobless claims in the U.S. Fall, helping to ease fears of a more pronounced slowdown. Here with more on the data is Michael McKee, Bloomberg's Chief International Economics and Policy Correspondent. So, Mike, it looks a little bit better than expected, and this sort of balances out the fears that we got on Friday that the labor market is really starting to fall apart.
I was trying to put this in a way that you would appreciate, and I was thinking it's a little bit like Deadpool and Wolverine. Every day we're going through a different time-varying universe in the markets.
I like that reference more than he does.
Every story is different, but you did see the numbers, and I'm sure you heard the sigh of relief on Wall Street at 8:30 Eastern time today. We got 233,000 initial jobless claims. And take a look at this chart. That is non-seasonally adjusted in the white and seasonally adjusted in the blue, and both of them are down, but you can see we have a seasonal factor at work in July, and it is starting now to fade out. Happens every July, and so did we take the previous numbers a little too seriously? And is this a sign that things are going to go back to the way they were earlier this year? We're going to have to wait and see, but it does seem that the fears of a labor market-led recession might be a bit overdone. We do have, as you mentioned earlier in the show, though, J.P. Morgan raising the odds of a 2024 recession to 35%, 45% in 2025 after all of these labor market and data disappointments that we had seen up until today. Remember, a couple days ago, Goldman Sachs raised their one-year recession odds to 25%. Interesting, though, yesterday, Goldman CEO David Solomon told us that he doesn't think we're going to see a recession. So a little bit of difference between him and the eco folks. I will, on that good note, leave you with one bad note. Now, this is at the end of July, going into this crazy month. These are the recession probably indicators from the Cleveland and New York Feds. They pretty much match up. But as you can see, they are much higher than every time we went into a recession before. So they're still seeing some issues out there in the economy, or at least they were when we went into August. But don't know exactly what that means.
Michael and McKeewy, thank you both for the recession odds here, as well as the Deadpool reference. I do thank you for that in particular. That is, and now joining us, Sinead Colton-Grant of BNY Mellon Wealth Management. She is the CIO there. And you saw the odds. You saw the odds rising. Perhaps more concerning to me is that J.P. Morgan raising the 45% recession odd into next year. What would it take to get there, particularly when you're still seeing some of the stronger data come through?
Well, look, Shonali, the claims numbers this morning, huge news for the market. I think when we're looking at where the risks are, most of this economy is really highly dependent on the consumer. So we're still seeing consumer strength, but where you could see some chinks coming in terms of the gaps is the labor market, which is why we've seen so much focus, and particularly following the payrolls data on Friday. It is continuing the theme of, from a consumer perspective, being slightly more value conscious, right? We've heard a number of companies reporting that consumers are perhaps trading down, looking a little bit for more value.
Staying home.
Perhaps staying home as well, yes, but also thinking about, what do I want to pay for streaming? What do I want to pay for a cup of coffee? And when you look at the price increases cumulatively since the end of 2019, a lot of products are up over 20%. So we tend to focus in markets on the year-over-year changes, but we've also got to take into account what's been happening since 2019. So look, our view is not that we see increased odds of a recession in 2024. We think the economy looks pretty healthy heading into 2025. Yes, we've seen volatility, but this is probably a better base to build from in equity markets.
I'm looking at the Atlanta Fed GDP Now forecast, and because we were talking before the show about the SOM rule and how it's been triggered, normally that would mean that we're in a recession already. However, we had 2.8% GDP growth in Q2, and now the Atlanta Fed is saying 2.9% in Q3. So that's a pretty strong economy, right? Do you expect that to continue to climb?
So let's remember, the GDP Now measure is coincident, right? So that's what you would anticipate based on the data that's come out since we had, the official Q2 GDP reading. It's absolutely strong.
Yeah.
And that tallies with a lot of the other readings that we've been seeing where you've had strong retail sales. When you looked at retail sales, ex-autos, that was up 8-9% in the last reading. Even the employment report, we had a lot of focus on a 4.3% print on Friday, but that's still an incredibly low unemployment rate. What's particularly encouraging there is that you're seeing the participation rate increase, and you had over 600,000 individuals join the labor market in July. That's the sign of a very healthy economy, more people looking for work.
So what does this all mean net-net? If you look at where positioning is, if you look at what the data says, is there more risk to the upside or downside in the market right now?
Well, we think it means two things. First of all, in terms of the Fed, it probably means, given we're seeing some slowing in data, that we're going to see somewhere between 75 and 100 basis points of cuts before the year end. However, the bar to do 50 in September is very, very high because a 50 basis point cut from the outset would be suggestive that there could be something more than the market is seeing, and I think it may spook the market. So from an investment perspective, we've been saying this for quite some time, but you look at the speed of market movements on Friday at the beginning of this week in terms of yields. If you're sitting in cash, we know that money market yields are moving lower. It's a good time to start extending duration, adding to fixed income. But also on the equity side, we remain overweight US large cap. You know, I think if you liked it last week, you probably like it even more because the valuations are much more attractive at this stage. And within that, you know, we're seeing some consolidation in the tech sector. We're seeing a broadening, which we think is healthy. And equities remain attractive, and we would be adding at this stage.
Yeah, because, you know, if I think about what's driving the index, it's really the giant mega cap tech stocks, right? And that's not really about consumer spending. That's about B2B spending and the AI play. So it doesn't really matter if the labor market's a little bit weak. I guess it does in that the Fed will be driven to cut more. But as long as the AI spending continues, that's going to drive those mega cap tech stocks higher, right? And as long as the positioning point that Sonali makes has been dealt with, is there any other shoe to drop in terms of market mechanics?
Well, look, I think the thing that took a lot of market participants by surprise over the last few days was how a butterfly flapping its wings in Tokyo in the form of the BOJ raising rates could have such a ripple effect on markets. But it's not the first time it's happened, right? You go back to LTCM, the yen carry trade unwind had a massive impact on markets. But I think you're seeing more of an impact. It is August, so it's a little quieter. But also the fact that the fundamentals of how FX trades have changed. Algo traders make a huge difference to how quickly things will move.
And this time around, you didn't need a bailout of a massive fund. So I guess that is some good news as well.
Sure, especially if it really has been unwound. I mean, 75% is close to done. All right, we're going to keep you here, Sinead, because we want to continue to talk to you here. Sinead Colton-Grant of BNY Mellon Wealth Management is sticking with us. I want to get another check on futures as we head into the markets. We've had such incredible volatility lately that, you know, we could be up 1 or 2% at the open and then down 1% at the close. Right now, we're up almost 1% on the S&P futures, up 1.2% on the NASDAQ futures, and the small caps are doing the same thing. Let's get a look at the individual stocks moving ahead of the opening bell because there's so much news coming across. As we close out earnings season, we're getting a ton of companies reporting after the bell yesterday, before the bell today. Here's Abigail Doolittle for a look. Abby?
So much news, Matt, and lots of volatility with these individual movers as well. Take a look at the shares of Under Armour. Right now up 14.5%. It looks like Kevin Plank's turnaround plan is working. They beat sales by about 4%. Not a small number either, $1.2 billion. They also boosted the profit outlook. Some of this might be a short squeeze. There is a roughly 13% short interest on the shares of Under Armour. Let's take a look at stocks moving to the downside. And these are two big movers. Monster Beverage down about 7.3%. A big miss. They missed adjusted earnings by about 10%, 6% on sales. And analysts don't like the planned price increases. But take a look at Bumble, down nearly 40% into today. On the year, the stock down 45%. So almost matching that in this one single pre-market session. And probably on the open, we'll be seeing something similar. They slashed the annual outlook. We're now looking at 1.2% growth versus the prior expectation of 8 to 11%. Let's finish on a winner, though, Matt. And this is, of course, Datadog. And these shares right now up 7.2%. They beat, they boosted. The cloud software company really doing quite positive. The street is positive on these results. On the year, though, the shares are still lower.
All right, Abby, thanks very much. We're going to check back in with you later. Coming up, Eli Lilly's Zepbound sales allow the company to boost revenue guidance as it breaks into the obesity drug competition in a very big way. This is Bloomberg.
headlines that move markets are on Bloomberg.
How worried are you about the U.S. election? It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. We cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate, just as we do with inflation. You know, we do scenarios. What if, what if, what if? Then what do we do? Where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world, because these things change over the course of time, as we have seen.
Bloomberg. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
DOJ or other authorities
Could face bigger challenges next.
Fed was going to keep rating World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Let's get to high interest now. Look at what's making headlines around the world. Warren Buffett's 5 favorite Japanese trading houses just got a little bit cheaper. The billionaire investor saw nearly $7 billion wiped off the value of Berkshire Hathaway holdings in Monday's market rout. But with those losses narrowing, the Oracle of Omaha has a chance to pick up more stocks at a bargain if he chooses to tap into the record cash pile that he has amassed. If you liked him last week, you're going to love him this week. Governor Gavin Newsom is declaring that today, August 8th, will be California Panda Day. That's because the San Diego Zoo will unveil 2 giant pandas later this morning. The black and white bears are a gesture of goodwill, as they're the first pandas to be sent to the United States by China in 2 decades. And Russia is declaring a state of emergency in its western region as Ukraine's military launched what appears to be its biggest incursion into Russian territory since the Kremlin's war began over 2 years ago. Janelle?
We're going to turn to the healthcare sector now. Eli Lilly raising its full-year revenue guidance after sales of its obesity drug Zepbound blew past expectations. Bloomberg healthcare reporter Madison Muller has the details, and amazing to see this rebound in Eli Lilly, the surge really, in the stock and in the sales. When we saw what we saw yesterday from Novo Nordisk, is one person's loss here another person's gain?
Right. It is really interesting, especially after what happened yesterday. I mean, Wegovy and Ozempic both missed sales expectations, and now Lilly is blowing past those sales expectations. And it just shows, I mean, both companies have struggled with supply shortages, but Lilly's shortages have really been easing because of the billions of dollars that they've been pouring into boosting production capacity. And it's really starting to show, as we're seeing in the numbers this quarter.
Yeah, I thought, first of all, it's amazing to see $1.2 billion of sales of, is that Zepbound and Mounjaro together?
And
just
Zepbound
Zepbound alone.
in December.
Yeah, it's crazy. And, you know, $1 billion was a definition of a blockbuster drug when I was a kid. Now they're going to be 5 times that this year. Is this just that they're a bigger company? They have more resources to put behind production. They can make more so they can sell more?
Yeah, I mean, that's a good point. One of the things that Novo is also contending with is price concessions. They're having to lower the price. Wegovy is a more expensive drug, so it's $1,300 a month, whereas Zepbound is $1,000 a month. And so they're having to lower the price in these negotiations with PBMs, and Lilly is maybe not at that point yet, but they're still ramping up quite significantly. So it's interesting to see the different dynamics that are at play right now.
You know, if you believe that Ozempic really started off this weight loss drug craze here, you had this amazing story out today. It's Bloomberg's big take for the day, and it shows a lot of surprising.
She wrote it.
She did write it, exactly. Yeah. It shows some really astounding revelations on where this is being most used. Who is the classical customer here?
Yeah, so I mean, we have heard that Hollywood and the Upper East Side of New York is kind of, at the beginning of this at least, where we were hearing about Ozempic, and we were hearing about it at the Oscars, and Jimmy Kimmel was making jokes, and what we found in our data is that actually places like Bowling Green, Kentucky, more rural area, it's Kentucky's third largest city, but it's not, you know, on the coasts, and it's not the very wealthy people in Hollywood that are taking these drugs. It turns out places like Bowling Green, Kentucky are where a large concentration of these prescriptions are going.
It is, first of all, it's also the home of the Corvette. That's where they make the Corvette.
Fun fact.
Which I love. But it's an amazing story, really well reported. I absolutely recommend that everybody read it. Congratulations on that piece. Let's get back over to Sinead Colton Grant right now, CIO at BNY Wealth Management. What do you think about these GLP-1 drugs? Because there was a time last year when we were saying, you know, this could be like AI Junior in terms of market moves, right? Not only do people buy these to get, you know, healthier, but then they stop going to McDonald's.
It is a fundamental change in what we expect these drugs to do, right? So since they've been unveiled, there is early data that talks about not only the benefits in terms of obesity, but also other potential benefits in terms of even combating addiction. So we think this is just the start, right? It's very interesting to hear that we're now seeing more need for price concessions, but this is just the beginning, and it has the ability not only to have a big impact in people's lives, but also potentially to boost U.S. productivity.
Janali, take a look at Eli Lilly's stock price versus Novo Nordisk over the past 5 years. I put a comp chart together, and you can see that the gains have been, Joe, you want to pull it up? You want to pull up that stock chart for me? The gains have been incredible. Now, this is just 2024. I want to see a 5-year chart. The comp function on the Bloomberg defaults to a 5-year, and you can see if you do that we're looking at 600-700% gains.
And the stock is $7.72 a share for Eli Lilly pre-market. Remember, years ago, this was a stock that was less than $500, right? I mean, it is just astronomical growth. You know, back to the GLP-1 drugs for a moment here, because it's not the only thing that's changing about consumer behavior. When you think about how consumers are changing the way they approach household products, or to Matt's point, restaurant chains, how do you think about how you are investing in consumer-heavy sectors, particularly where we are in the economy right now?
Well, first of all, I would say that they are not sectors that we are overweight. I think there are a number of changes happening which are tied to the broader economy. The sectors that we are overweight are technology, healthcare, and industrials. But within the consumer sector, look, it is on the front line in terms of the impact of inflation. If you're going to see a slowing consumer discretionary comes under pressure. But I think what we've been seeing in the staples is really interesting, where you've been seeing for quite some time more price sensitivity. The value shopper, the cost-conscious shopper, and it also links back to the reaction we saw to payrolls, because ultimately that's related to wage growth, it's related to the state of the employment market, and it tells you where where market participants are concerned about the balance of risks.
What do you think about the rotation into smaller cap or mid cap stocks if the Fed does end up cutting, 100 basis points this year and keep going into 2025?
So we need to level set here. The reason that small caps have been under pressure so much this year is because many smaller companies use floating rate debt. And when they do have debt that's maturing, it's maturing much sooner, 2025, 2026. And so the fact that they can refinance at lower rates, that's absolutely a positive for small cap. However, the first rate cut, 25 basis points, that's kind of neither here nor there. But here's what we're watching. One, we think it's a little early in small cap, because if there is a concern about a slowing in the economy, that's where small caps are focused. They're much more domestically focused. And so it's probably a little early to go back into small caps wholesale.
Sinead, we have to leave it there. That is Sinead Colton Grant, CIO of BNY Wealth Management. Now, coming up, we're going to take a look at the companies making the most buzz today. That is Social Climbers, and it's up next. Stick with us. This is Bloomberg.
This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg. A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything.
It's time now for Social Climbers, the companies making waves this morning on social media. First up, the West Coast coffee chain Dutch Brothers needing a strong shot of caffeine today after reporting a tempered growth outlook. The company projected it would only open a maximum of 165 shops on the lower end of guidance. And next, the online dating app Bumble is heading into its biggest decline on record after slashing its annual revenue outlook. The report signaling that an overhaul of its flagship app has failed to reignite growth. The company's struggles is indicative of a broader challenge plaguing the U.S. online dating industry since the pandemic. People are out to play, I guess, these days. Finally, Monster Beverage is seeing revenue and drink volume slowing to its worst rate since 2020. The energy drink maker says its target blue-collar demographic is struggling with rising inflation and interest rates. Monster is also facing fierce competition from Red Bull, which has been taking its market share. You can follow all the latest company buzz on TREN Go on your Bloomberg terminal.
Look at these Monster shares. It's pretty amazing to me, the business, which I feel like it started with Red Bull, the initial obsession with these highly caffeinated or taurinated drinks, but I can't drink them. I feel like I'm having a heart attack if I have one of these things.
Yeah, people are drinking Celsius on the Goldman trading desk these days. They're trying to stay healthy, Matt. Stick with us for the market open. This is Bloomberg.
What prompted you to want to get out of just doing surgery to be an administrator and a hospital leader?
Watching others who did it well. I had a dean who recruited me from Birmingham, Alabama to Minneapolis, Minnesota, which is a big jump to convince me to move my family. I realized over time that my training as a surgeon brought a set of credible things to the table. One, if surgeons have a measure of emotional intelligence, not much of our training reinforces that. It reinforces skill, not necessarily emotional intelligence. But if a surgeon has some self-awareness and emotional intelligence, what they bring to the table of leadership are three fundamental things. Number one, they do everything in teams. Their operations, their patients they see is all team focused. Number two, they value process, but they hold themselves very much accountable to execution. They understand that it's good to explore a patient, but what really matters is that you take the tumor out. And then number three, they make difficult decisions on incomplete information. Those things I realized that I could bring to the table as a leader if I had a sort of a passion for working with people and had some sense of self-awareness.
We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. 20 seconds to go until the opening bell. We do have futures up right now, more than 1% on the S&P, almost 1.5% on the NASDAQ. But remember, we're looking at a market that has a ton of volatility in it. Yesterday, we were up 1.5% on the S&P, and then we closed the day down in the red. Here you see the New York Stock Exchange, the bell being rung there by Goldman Sachs Asset Management. Down on the NASDAQ, you have the bell being rung by Abacus Life. In terms of the action as we get started in trading, you do see green arrows on the screen. The S&P in the first seconds of trading is up 1%. The NASDAQ up a little bit more than 1%. And the small caps, the mid caps are gaining as well, a little bit more than 1% there. We have seen bond sales today pushing rates up. And I know Shonali is very excited about the 2-year, which is about 4.05 as we speak. Shonali?
I am excited about the 2-year, but let's get excited about some stocks to watch as well, because we're taking a look at Eli Lilly and Bumble. We're taking a look at Bumble just dropping more than 33%. Shares plunging after slashing its revenue outlook. And Eli Lilly, as we've been saying, jumping as the company raises its 2024 sales outlook for the second time this year, thanks to demand for its weight loss drug, Zepbound. Eli Lilly up more than 13% at the open. Let's take a closer look with Bloomberg's Abigail Doolittle.
Yeah, Shonali, this is the best day in a year for Eli Lilly, really popping in this multi-day chart, really gives context to the move parabolically straight higher. What's amazing about this, up 32% year to date into this report, and out of the great financial crisis, basically a straight line higher. This stock up more than 3,400%, really pretty incredible. But it had everything to do with this great quarter, massive adjusted earnings beat of 50%, $3.92, so that's not a small number. Relative to sales, a 13% beat. Let's take a look at revenue. In fact, the annual outlook, as Shonali, of course, was just talking about boosting it for a second time. You can see this really beautiful increase moving in the right direction on not just Zepbound, but also Mounjaro, but mainly Zepbound for sure. In terms of healthcare and other sectors where we're seeing these types of beats, well, interestingly, healthcare is the best. We're seeing 57% of the companies that have reported so far in the healthcare sector beat. Then there's tech, energy on the bottom, staples, but still a very healthy 32%. I wonder though, Matt, is that really strength for these companies? Clearly for Eli Lilly it is, or on the part of other companies, it could also be some strong management from the C-suite.
Right, well, we typically see, I know on the bottom line, companies beating by like 75 to 80%. So a lot of this is just about how you guide your analysts, Abigail, right? It's like how you play the game.
Yeah, absolutely. And my first lesson in that was in 2000 when companies missed, and then finally management teams got much smarter in terms of, set the bar low, beat it, and then bring folks higher, and I think that's a lot of what we're seeing now for sure.
Yeah, absolutely. Abigail Doolittle, thanks very much for that analysis. Joining us now to talk more about this, Shatara Sundar, Global Equity Strategist at JP Morgan Private Bank. Thank you so much for joining us. What do you think about earnings season this far? I mean, it actually looks very good. Not just the surprises, because those can be massaged, right? But the actual growth is strong. I think we're looking at 11, 12% profit growth year over year, and we're almost done with the S&P 500.
Definitely. First, thank you so much for having me. But that's exactly right. What we're seeing from an underlying growth perspective in earnings season so far is year-over-year growth of 12%. And we're seeing surprises above average. Now, what you're also seeing is a little bit more volatility and dispersion under the hood. And when you think about earnings season, and you also think about the macroeconomic environment right now, what that means to us is the focus on quality, focusing on companies that have strong free cash flows, low debt on the balance sheet. Those are the companies that you want to be focusing on. And this volatility actually has created a lot of dispersion where many of these higher quality companies are now trading at more reasonable valuations given the volatility we've seen, not just over the past week, but really over the past several months.
In a lot of ways, this volatility has been very welcome for what has been increasingly becoming a stock picker's market. But at the end of the day, over the next couple of months, what is going to steal the story? Is it the macro? Is it these positioning level kind of swings here that are sweeping up all these names? Or is it the fundamentals?
So I think that's a valid question, and it's one that we're all grappling with at this point in time right now. I think over the next couple of months, you will see volatility, whether it's positioning, whether it's macro, whether it's earnings. But at the end of the day, we are investing for the long term. We're guiding our clients to invest for the long term. So what that means is stock prices trade on fundamentals and earnings growth over the long run. So while we might see some volatility, at the end of the day, the underlying earnings growth of the entire stock market is strong. Indeed, actually, by the time we hit fall and we enter 3Q earnings season, less than 5% of the S&P 500 sectors are going to be experiencing earnings recessions versus 70% 2 years ago. So while the market seems to be focusing on whether or not the economy is going to enter a recession, the reality is that many sectors within the market have already experienced their recession.
Yeah, of course. I mean, it seems so silly, right? What has changed if the market narrative before last, let's say Wednesday, was these mega cap tech stocks are riding the AI wave and it's going to boost the S&P 500 6,000. So, okay, we get the Japanese carry trade being unwound. That's pretty much done. We get the economy slowing down on a weaker labor market. You knew that was going to happen. The Fed raised rates 550 basis points in a year, right? Now we're going to get the cuts that we expected as well, maybe a little bit more. So can't we still be bullish, especially since earnings are beating expectations?
Yes, I think the bottom line, if you take anything away from this conversation, is yes, I think that even if there's volatility in the near term, we are constructive on equity markets moving forward for the fundamental reasons that I alluded to before, but selectivity is key. The biggest, oh, please.
I'm always being the bear to Matt's bull right now, but you think about that 5% of the S&P 500 really facing that earnings recession into the third quarter. What is that 5% looking like? To the extent that investors have to avoid at least pockets of the market, where are the places to avoid?
So I think the biggest thing at this point in time is we are advocating for clients to avoid the areas where a lot of the earnings growth has been driven by leverage. So anything that has a company with high debt on the balance sheet, that is an area where we're concerned about moving forward, because even as rates come down, the concern about what economic growth is going to mean and whether or not they're going to need to be dependent on capital markets for financing, that gives us concern. However, where is there opportunity? And that, I think, is what is so exciting. So we're seeing opportunity within pockets of tech. The biggest thing that I like to remind people is that the S&P 500 tech sector is up 14% so far this year. However, if you stripped out one company, NVIDIA, the tech sector is actually only up 2.5%. So we believe that there's an opportunity from a broadening perspective within the tech sector. And even outside of that, U.S. equity markets over the past year and a half, 60% of the returns that we've seen in the S&P 500 have been driven by these magnificent seven, these mega cap tech names. As we start to see more of these underlying companies within the S&P 500 go from earnings recession to earnings recovery, we think that there's an opportunity in broadening of the rally within U.S. large cap equities, and particularly within parts of the tech.
So you don't want to get too broad. I mean, you're not selling your NVIDIA and buying Russell 2000. You're just looking for, you might as well just buy the Qs, right?
So the biggest thing that I would mention there is even within the Qs, there's a lot of concentration within the mega cap tech space. Now, that selectivity is key. Your exact point is valid. You want to ensure that you're having access to parts of the market where the quality is high and where the competitive advantages are growing. And right now, what we've seen in terms of the Qs and in broader is that artificial intelligence is what has been driving the market so far. And a lot of that value has accrued primarily to semiconductor companies. Now, when we think about what prospects will look like moving forward, AI is not going anywhere. I think we can all agree on that. But there are parts of the value chain that have not accrued to the same extent.
How concerned are you to that end about concentration risk at this still in the market?
So it's something that we're vigilant about always. I think that concentration levels that we've seen within the S&P 500 have reached the highest levels that we've seen in many, many years now. So while concern maybe is not the word that I would say, we're definitely observing it and we're cognizant of it. And in that way, we think that there are opportunities moving forward in areas outside of that concentration. And the biggest thing that I'll mention maybe is that concentration would worry me if the underlying fundamentals of those companies were deteriorating or if they were highly indebted or unprofitable. Now, that is not what we're seeing in these mega cap tech names now. Strong balance sheets, high free cash flow generation, strong margins. So when we think about equity markets moving forward, we're still constructive on that space. It's just when we think about the opportunity set and the incremental opportunity set, broadening is where we're very constructive on.
Sitara, we can't wait to have you back to talk more about that opportunity set. That is Sitara Sundar, Global Equity Strategist over at JP Morgan. And Matt, I've got to say, the first thing I did was in every individual equity, you can go to FA Go.
Yes.
And you can see exactly how much debt they are carrying on their balance
Absolutely.
sheet.
I also love MODL Go.
Yes.
I think it's a great function to look
Absolutely.
at all those
fundamentals.
data. Okay, coming up, Warner Brothers Discovery posts a multi-billion-dollar charge writing down the value of its TV network. We'll take a look at the ever-shrinking Time Warner AOL when we come back. This is Bloomberg.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in. We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
This is Bloomberg Open Interest. A quick check on stocks, of course, that floated right into green territory after the jobless claims data came in nice and promising. S&P 500 maintaining gains right now of more than 1%. The NASDAQ 100, same goes. Russell 2000 up more than 1.1%, Matt.
All right, let's get to the top calls right now. This is some of the analyst action that we're focused on this morning. First up, Bank America is cutting Celsius Holdings to an underperform, even though Shinali drinks a ton of it every morning. The energy drink maker is the only sell equivalent radio from B of A right now. The analyst says the category itself just ain't what it used to be. Next up, KeyBank Capital is cutting Topgolf Callaway to a sector weight. The company is reporting weaker than expected sales at its driving ranges. Topgolf Callaway is undergoing a strategic review of its driving range chain, including a potential spinoff. And finally, TD Cowen is lowering its price target on Warner Brothers Discovery to $14. The media giant missing, well, it was a giant, not so much anymore, missing earnings expectations and posting a $9.1 billion charge for writing down the value of its TV networks. Some analysts calling the report ugly.
Sure was. $9 billion of a write-down. We're going to stick with Warner Brothers Discovery, with Bloomberg's Paul Sweeney here now with us. Before Bloomberg, he spent over 20 years as an equity analyst covering the media space, so has seen the many faces of Warner Brothers and
an investment
Discovery.
banker, and an investment banker pitching deals before that. I mean, exactly. You were all wrapped up in this when it was Time Warner AOL, weren't you?
Well, listen, would you want to put these two companies together? Is this an acknowledgement that perhaps Warner Brothers and Discovery didn't work?
Well, at the time, the whole argument was scale. I mean, you have to compete against Netflix, Walt Disney Company. You had to spend billions of dollars on programming to launch these streaming services, so you needed to get bigger. Let's take Discovery, let's take what was left of Warner Brothers, put them together and see if that can work. It hasn't worked. What's happened is they have a lot of debt on their balance sheet that really makes operating the company and investing in the company very difficult for them, and they continue to have to fight these really huge headwinds, which are everybody's still cutting the cord. And so what did they do? They wrote down the value of their cable networks by about $9 billion. That's roughly half the market cap of this company. So real acknowledgement that that business, not just for Warner Brothers Discovery, but for the entire industry, really under pressure.
Is this just, it's like a story of hubris and ego. I mean, starting with Time Warner AOL, right, and Steve Ross, this was a bad deal to begin with, and at the time, the biggest deal ever, right, $120 billion. That didn't work. They had to spin off AOL a few years later because it was worthless. Then AT&T came in and bought Time Warner for like a 50-60% haircut. Then Discovery, which is making like home and Garden TV, says we're going to buy Warner Brothers by taking out $41 billion in debt.
Exactly. So it's made a lot of people rich along the way, besides
Well, it's made David Zaslav rich.
Yeah, so they get paid very well in the media industry. Forget about
$50 million
Forget about Wall Street bankers getting paid well. The best paying industry, I think, is the media business year in and year out. So what you're left with is Warner Brothers Discovery. They have great assets, but they're trying, like everybody else, to navigate this mix or this move from traditional cable television, satellite delivery, where everybody made money, to streaming, where it's so much harder to make money.
What do you think of this prior report that was out there of potentially splitting the whole company up? It was interesting. We spoke to Golden Tree CEO Steve Tannenbaum, big debt investor. He said he loved the idea. When you think about debt on the balance sheet now, how do you start to take care of the issue? Is a spin-off, a split-up?
This is a company that has done a great job paying down their debt. They have. They've gone from over $50 billion of debt to $40 billion of debt. They have great free cash flow, believe it or not. They're generating a lot of free cash flow, which is helping them pay off debt. Unfortunately, the core business of cable television is declining faster than their ability to deleverage their balance sheet. So they're going to try to keep at it and try to compete against Netflix's and Disney's and Amazon and Apple and some of these huge companies. But at the end of the day, you're right. There might be pressure to break this company up, spin it off.
Weighted average cost of capital does not look good at all. And this is, you know, I saw a quote in a Moffett-Nathanson note where Zaslav says, am I disappointed that the trends in the linear business haven't been a little better? And he says, you know what? It is what it is. We're doing the best we can, and he's writing down $9 billion as he steps onto his private jet and goes back to his $120 million mansion. How much longer is John Malone going to abide this?
Well, John Malone is big investor in this company, and I think he's going to be an agent for change, if you will, to say, this isn't working. These assets are worth more than the stock market is valuing them today. Let's think of a new ownership structure here. So whether that's splitting up the company, spinning off some businesses, or maybe they just keep it together and try to just continue to pay off debt.
I want to get your thoughts real quick, 30 seconds here, about this lawsuit against the NBA. How big of a deal is it to them to have lost that contract to a new age tech company? He said, Zaslav said, at this point, we've handed it off to our lawyers.
Yep, it's a big deal. The way you get higher rights for your cable networks from the Comcast of the world is to have really compelling program. And for Warner Brothers Discovery, some of that really compelling program was the NBA. They've now lost it. So now when you go to Comcast and say, I want you to pay more for my cable networks, they're saying, pay more for what? So it's a real problem.
Paul, we thank you so much for being here. That is Paul Sweeney, co-host of Bloomberg Surveillance and Bloomberg Markets on Bloomberg Radio. Now coming up, billionaire Dmitry Balyazny is on a hiring spree, an expensive one at that, to fix his hedge fund's equities trading business. We're going to discuss that in our Wall Street Beat next. Stick with us. This is Bloomberg.
Fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg Open Interest. Let's get a quick check on what's going on in stocks this morning. We see the S&P 500 just about 20 minutes into the session, up 0.8%. The NASDAQ not as strong as it was at the open, but still up 0.2%. And the Russell 2000 gaining 1% as bonds fall and yields rise. Sonali?
And it's time now for the Wall Street Beat. Balyazny said to be spending more than $200 million on a hiring spree to help fix its equities trading business. For more on this Bloomberg scoop, we are joined now by Bloomberg hedge fund reporter Nishant Kumar, who is the lead on this story. And you take a look at the money being spent. We knew that there's been a talent war going on in the hedge fund industry. Now we're talking about a talent war at the very tippy top of the big multi-strategy hedge funds. What exactly is going on?
Well, there are not much talent available that all these big platforms who have like plenty of money to spare can hire. Really, there is this shortage of talent is sparking this war for talent. Balyazny is in this case has shifted his focus from hiring relatively less expensive junior people to really going for the top tier traders. And that's why we are seeing these large numbers. Traditionally, historically, Balyazny has spent a % of its AUM on hiring every year. This time around, it's just that they are hiring fewer people, but higher quality larger name hedge fund managers. That's why we are seeing these amazing big ticket hirings.
Nishant, why isn't the pool from which they can hire bigger? Don't kids want to be hedge fund managers? Don't they want to be masters of the universe?
Well, the pool has really shrunk because the traditional training ground of some of these hedge fund portfolio managers, which used to be prop desks, they are no longer there. So the new supply is constrained, and everyone is after this very limited pool. And it's a very specific kind of talent they are looking for. Anyone who can manage $1 billion, build their team, who have leadership quality, train their analysts to become a senior portfolio managers, and those who don't lose money often and can really meet the very tight risk limits that some of these hedge funds impose. That kind of talent is really not available in the market.
It's interesting. Some of this talent is very young as well. I think about Justin LaBelle alone, for example, who is very senior over at Citadel, runs an equities business there, is barely 40 years old, right? And so you think about the talent entering the industry, the rush to get them on staff. Nishant, what does a trader go for these days? I mean, how much are top traders being paid?
Well, I have written about someone getting more than $120 million in potential compensation. We have to understand that this is not like they walk in and sign up and get $120 million. This money is paid over a few years, and it's linked to, a vast majority of it is linked to how do they perform, how they build their team, what kind of P&L they generate in future. So it's very variable. Yes, the big headline number looks great, but it's linked to how they do at their new firm.
All right, Nishant, thanks so much for joining us. Nishant Kumar there out of London. Time now for the Trading Diary, what you need to be watching for the rest of this week. The media earnings, is it Thursday?
It is certainly Thursday. It's almost Friday.
It's Shanali's Friday. The media earnings continue this afternoon with Paramount earnings, plus earnings from Expedia and Sweetgreen with no S after the bell. We also hear from Richmond Fed President Tom Barkin this afternoon. Tomorrow we round out the week with the Baker Hughes rig count, but without Shanali. She won't be here. Carol Masser, my old partner,
I will be
in place.
lakeside somewhere, but I will be rooting you on.
You deserve it. Enjoy yourself. This is Bloomberg.
biggest risk in property and casualty, is that now climate change?
Yeah, so absolutely. When you look at natural catastrophes, the number of events has significantly increased, and not only the very big events like hurricanes, but also what we call secondary perils, so wildfires, floodings, and drought. And this leads to the fact that you have far more events and therefore a much higher cost of all of the natural catastrophes.
How do you really assess the risk of climate change? Because how can you possibly know whether there's going to be a hurricane or a flood? Is it just based on the past or the projection of the future? Or how do you do that?
Since the dynamic has changed, we need to also look forward. And what we do a lot, we work a lot with scientists who understand what the warming of the Earth and climate change will mean for the question of taking risk. And secondly, we take much less risk than we used to take because we have to be careful.
So let's suppose there are a lot of hurricanes. Is that good for property and casualty insurers or not? Good because people say, well, there's going to be more hurricanes, I should buy more insurance, or not good because you got to pay a lot of claims?
It depends. I would say it's good because it creates the awareness to do more prevention. What we see today is that, as I said earlier, there is more events. It becomes more and more difficult to insure, and therefore we work a lot with our customers around preventions.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, good Thursday morning from the Bloomberg Interactive Broker Studio in New York City. To our worldwide audience, we're streaming live on YouTube as well. So head over to that youtube.com. I think that's where you go and search Bloomberg Podcast, and that's where you will find us. Coming up, we're going to check in with Claudia Sahm, new Century Advisor, chief economist, and a Bloomberg Opinion columnist. She's got a column out today saying, my recession rule, the Sahm rule, was meant to be broken. So we'll check in with her. Brian Whalen, one of the smarter folks we talked to on the bank's chief investment officer and general portfolio manager at TCW on recent market turbulence there. Those TCW folks are very, very good in the fixed income markets. We'll talk to them about what's happening there. Michael Halen, Bloomberg Intelligence senior restaurant and food service analyst on restaurant brands earnings. Burger King. I like Burger King. Why not? But right now, let's start it all off with Lisa Mateo and get a Bloomberg Business Flash.
You got it. Market Drivers brought to you by Interactive Brokers Bond Marketplace. Access their vast selection of over 1 million global fixed income securities with no markups or built-in spreads and low transparent commissions. Learn more at ibkr.com/bonds. All right, stocks getting a bit of a boost. Initial jobless claims posted the largest drop in almost a year, falling by 17,000 to 233,000 last week. The prior was revised up to 250,000. We're also getting data on wholesale inventories for June. Taking a look at it month over month, the survey was for 0.2%. Look at that, the actual coming in 0.2%. And the prior was also the same, 0.2%, so not much of a change there. We'll head to the bond market. The 2-year yield, 4.05%, up 9 basis points. The yield on the 10-year, 3.99%, and that's up about 5 basis points. As far as commodities, we'll hit spot gold. That's higher, 2,411 an ounce. We have Brent crude, $78 a barrel. WTI crude, that's over at $75 a barrel. Looking at the stock 600 right now, down about 0.1%. And I want to take a look at the Nikkei. That's down about 0.7%. Going to currencies, we have the Japanese yen. That's down about 0.3% at 147.14 against the dollar. That is your Bloomberg Business Flash. Back to you.
All right, thanks so much, Lisa. I'm Alex Steele alongside Paul Sweeney. Happy Friday to Paul. Yes. Happy Thursday to everyone else who's suffering through Friday.
5-day work week. I don't know what you guys are doing.
Yeah, I know. This is the way. Paul's so happy on Thursday. It's like really nice.
But so, I will be here the day after Thanksgiving.
Yes,
it's
true.
I will be here all Christmas week when everybody else is all doing their thing. Just letting you know.
I'm not throwing shade. I'm just at this moment extremely jealous. So to the market, I have to say, I don't think I've ever seen the market react this strongly to an initial jobless claims print.
Great point. Great point.
Yields bouncing higher because we came in a little less than expected on jobless claims.
Right, exactly.
I don't know what that tells us.
I don't know. I mean, we had this strong morning yesterday. We handed that off this green screen to Carol Master. and Matt Miller, and they fumbled it.
They did,
and the
yeah.
market sold off. So we'll see
Yep.
what happens today. But again, it looks pretty solid across the board here. And again, the jobless claims numbers, as you mentioned, a little bit, I don't know, a little bit weaker, I guess.
Yeah, but like, and it's like good news is good
Yes,
news.
I know.
It's very confusing, and it just makes me feel like there's still a lot of uncertainty in the market. It makes me question whether or not we're still complacent, etc. There are also some individual stocks that are moving that are fun to talk about. Let's go to Bailey Lipschultz, Bloomberg News senior equities reporter, and as Paul points out, he has another Finance Bro vest. For those, what was it, yesterday you had the vest or the day before?
But yesterday was fleece. I don't know what this material technically is.
That's
called,
like
but it's not
the
fleece.
rainproofy thing.
Right,
Like
yeah.
it's a little water-resistant vest. Yeah.
Protected.
So I want to go through see how many different styles of vests that Bailey Lipschultz can bring in. Eli Lilly, though, having a great day.
Yeah, great day, beating expectations, really being driven by their weight loss drugs. Mounjaro and Zepbound absolutely crushed on 2Q, boosting guidance by $3 billion for the full year revenue. Weight loss drug, diabetes treatment. Not only were they strong in the U.S., Mounjaro actually was quite strong ex-U.S., so seeing some of the rippling effects. One other drug that really didn't get talked about enough, in my opinion, is Verzenio, which is a breast cancer treatment that also beat expectations. So that's another driver for this top and bottom line beat.
Well, I mean, you're talking about the weight loss drugs. Great big take story on the Bloomberg Terminal take, focusing on Bowling Green, Kentucky, a town I know very well, know a lot of good folks down there in Bowling Green. They are, you know, I think pound for pound, kind of the weight loss drug capital of the United States, and just a great story, just kind of going through what's happening in that part of the world with the weight loss drugs. It's a real thing, and it's helping a lot of people.
No, it is, and it's that really Madison and the team on that story really dove into the benefits for, again, people maybe at a top level basis take it as, you know, an LA drug or a New York City drug, but seeing it really play out and benefit so many people here in the U.S.
The compound drugs I get really confused about. Like, are they legit? Are they okay?
I don't know that.
I mean, it feels like yes. Anyway, I got a lot of questions when it comes to that. Bumble, let's do a total flip here. That was really terrible. I mean, to guide at a certain level and then to miss and lower so spectacularly.
It's just for, the numbers you're acknowledging, Alex. They now expect annual revenue to rise between 1% and 2%. Earlier this year was 8 to 11%. So you're not even close. They're trying to reinvest the business. They're trying to reposition it. They're leaning still into the underlying argument, or the underlying kind of business that Bumble proposed years ago before they went public in 2021 was a woman-first dating app. So they are the first person to send a message. You're not having a guy send a weird message. You match, the woman starts the conversation. But this company going public back in 2021 absolutely skyrocketed from its IPO. So February 2021, price at 43, traded above 80 3 days later, now trading at $5.
Wow.
So
people aren't swiping? Is that the thing?
People aren't swiping. Like, looking at some of the analyst reports that really stood out. So you're seeing a slowdown not only for their app, but also competitor Match Group has Tinder and Hinge. They're kind of competing for the same pie, and a couple analysts really called out basically that younger consumers aren't willing to pay.
Well, I'm going to say, in this room, you're probably the closest to the demo that would be in the swiping thing.
Yeah, you're not going far on that,
Have you
Paul.
swiped there?
I'm a married man.
I know you're married, but back in the day.
You dabble when you're young and in your 20s and live in New York City.
See, I just go
but
to
I wouldn't
a bar.
pay for it.
I go to a bar. Come on, that's
You have to meet the people where they're at, though.
Yeah. I met my husband on a rooftop. What are you gonna do?
There you go.
Okay, let's go to Monster Beverage. That stock is down a whopping 12%. They're raising their prices, right? This feels like a really odd time to do that.
And that's the thing that stood out when you look at some of the analyst notes. They're trying to deal with a weakening category, so consumers are spending less on energy drinks. They're also dealing with general consumers spending declining, especially as they called it out, not only in the energy drink category, but also at convenience stores, people popping into gas stations when they're refueling, grabbing an energy drink. But as you mentioned, Alex, 5% price hike in an environment where people are pulling back. Really a head scratcher. And we talked about that with a couple other stocks that have been reporting recently. And you're dealing with kind of trying to expand those gross margins, but underlying demand maybe not quite there.
Yeah, that's a
energy drink. Are you an energy drink person?
God, no.
No, are you?
Again, back in my day, I think I thought
How old are you? 80?
I'm 30.
Okay.
When I was 18, I didn't drink coffee until college. So you kind of like use sugary caffeine drinks and ignore the...
The most I ever did was Mountain Dew. I mean,
Yes, right.
that's what he did.
Exactly.
Back in my day.
Yes,
Yeah.
very good. We were just talking about Coca-Cola. I mean, I love Coca-Cola, but I like Pepsi too. I don't.
My daughter had her first Coke, like, I don't know, 6 months ago or something.
First?
Oh,
Yeah. And she was like, her whole face, like, transformed. She was like, what is this drink?
Exactly.
Anyway, every time I have a Prosecco, she's allowed a Coke. That's how we do it
Oh,
now.
that's good.
Because I don't drink that much, so then it therefore moderates everything on those lines. All right, Bailey, thanks a lot. Thanks, Finance Bro, Bailey Lupschultz, Bloomberg News senior equities reporter. Looking forward to his outfit then and his next sweater vest tomorrow.
Right, very good. All right, let's check in with our good friend Claudia Sahm. She's a chief economist at New Century Advisors, former Federal Reserve economist, and a Bloomberg opinion columnist. And she's got this thing called the Sahm rule. Now, I'm not an economist. I think marginal revenue, marginal cost, that's my extensive knowledge of economics. Claudia, thanks so much for joining us here. Can you just summarize for our listeners, our viewers, what the Sahm rule says, and was it triggered on Friday with the jobs report?
So it's a recession indicator. So it uses changes in the unemployment rate over a year to, it has a threshold and compares that to historical episodes of recessions. And, that's when it turns on, it has turned on historically in the early months of, not a forecast, in the early months of a recession. And with the employment report on July, the Sahm rule crossed the 0.5 percentage point threshold. And so it's indicating a recession. Are we in a recession? My expert opinion, looking broadly, is no, we are not. But that increase in unemployment rate that we have seen over a year plus is very disconcerting. We're not pointed in the right direction in terms of where we're trending.
This is why I really loved your Bloomberg opinion piece yesterday, because it feels like a lot of people are coming on talking about your rule and how that is de facto then we're in a recession as reason for the Fed to do something maybe bigger or an emergency way. And you come out with an article that says U.S. isn't in a recession despite the indicator. My recession rule was meant to be broken. What does that mean?
When we think about this cycle from the pandemic on the last 4.5 years, the disruptions to the U.S. economy have been in many ways unprecedented. And in particular, we've had some really big disruptions to supply, which are typical boom and bust indicators, recession, high inflation, low inflation. Those are about demand. And so the Sahm rule, in my opinion, is getting overstated by some of the really abrupt shifts in labor supply in the last several years. And that's just, some of the unemployment rate increase is the good kind. It's people who've come in, want to work, they will get jobs, it'll be growth. But in the interim, that looks like the unemployment rate rising. In the recession, there's some of the bad unemployment in there too. So that's where it gets really hard. And, it's difficult to hear. I'm happy to have sparked a robust conversation. This is really, really important to know if we're in or headed towards a recession, because there are policy actions that can be taken. And so, I'm using the tool and other data just like anybody else.
So, Claudia, what do you make of an unemployment rate of 4.3%? To me, in my experience, that's still low. I guess if you want to get concerned about the trend, i.e. it's moving higher, that's a concern. But in and of itself, 4.3%, how does that kind of stack up for you?
Right. So if our concern is about the direction we're pointed in, are we headed towards a recession? Are we in a recession? The relevant metric is the change in the unemployment rate.
Okay.
I mean, the level is important. Sometimes it's unsustainably low. Like earlier when we had the labor shortages, the unemployment rate in the United States, when it got down to 3.4%, that was because we were missing some workers too, right? Like that wasn't going to stick. So sometimes, within bounds, sometimes the level does tell us something. But at 4.3%, this is very much consistent with the demographics of our workforce. We have an older, more experienced workforce. 4% unemployment, that's much more like you would expect or predict. So that 4.3 is not like, oh, wow, this is really low.
Right.
It's not sustainable. And we've gone into recessions in the past with lower unemployment than now and also higher. So the level itself is not a protection against a recession.
Paul pointing to himself when he said older workforce. Seasoned. We think seasoned.
Experience.
Yeah, experience.
Yes.
Claudia, to that point, how do I understand the fact that you had a huge move in the bond market when initial jobless claims came out? They're volatile, they're seasonality, they change, and yet we're having such market sensitivity to that. Where does that kind of tell you about where we are?
Right. Well, this is very much this question about the dynamics, the recession, right? This isn't about the Somme rule, but it captures it, right? This is why this almost worked historically, is you get periods where the unemployment rate starts coming up gradually, and then it picks up steam, and then it goes up a lot. And we had some signals that we're in this stage. It's been going up slowly and gradually, and with the July employment report, things looked like they were picking up steam in the wrong way. And so that's the concern. And then what we're looking for in claims data is that momentum there? Or was it just the weather or this or that, And so I think that's this reaction, because we're kind of on this, it's not like we're on the knife's edge, but the dynamics are, like, it makes a big difference at this point if the increase in the unemployment rate speed up or not. Because once they get going, they tend to, you have these negative feedback loops. And then you're not talking about a 0.5 percentage point increase in the unemployment rate, you're talking about a 3 percentage point increase.
Wow. Claudia, talk to us about the migration component to the labor market. How has that impacted the numbers? Because again, we've had a surge in migration on the southern border for the last several years. How's that impacted the numbers, do you think?
Right. Well, first thing, having the immigration, and we've had other prime age labor force participation is higher in the U.S. right now than it's been in general. So it's not just about immigrants, but it was very important to have more labor supply address these labor shortages that we'd had, and this has taken pressure off of wages and inflation, and so that's very good. And then we have more supply of workers, and hiring has moderated, right? Like the pace has slowed down some. So now we're in the opposite direction of the jobs need to catch up to the workers. So if you think about this is all an adjustment, right? Like it's more of a timing issue. And when the reason that the labor supply causing increase in unemployment rate is a good thing is when those new workers do get jobs, they help us expand the economy, which is the exact opposite of this kind of recession watch contracting. But I will say, employers have different margins to adjust labor demand writ large, and we have seen the hiring rates at employers come down to levels that are, line up with much higher unemployment rates than in the past. So it could be just employers are not wanting to lay off as much because they got burned in this crisis. And so we're seeing, it's harder if you're coming in labor force to get jobs. So this is a really tricky labor market to read, and that means every single scrap of data we get on the labor market could cause a big
deal. So Claudia, before we let you go, we have about a minute left. I'm looking at WIRP, WIRP on the terminal. It's looking at 25 basis points of cuts in the next 3 meetings. Is that fair pricing right now?
That is my baseline. I think that's fair pricing. The Fed, there is more slowing in the labor market than I think is comfortable. We don't need to get into a recession for the Fed to start acting. So I think a little picking up the pace, some and 3 consecutive cuts makes sense, but they're going to be very attuned to, we've got more information on the labor market between now and September.
All right, Claudia, thank you so much for joining us. Really appreciate getting some of your time. Claudia Sahm, she is the chief economist at New Century Advisors, former Federal Reserve economist, and a Bloomberg opinion writer, so we appreciate getting some of her time. She's the creator of the Somme Rule, a recession indicator, which says maybe it's not tripped today, but it's certainly suggesting that the risks of a recession are higher, certainly in the near term.
But I love her candor of look, I think some people are taking this and running with this a little bit too far. There's some more nuances. I love that because you don't get that very often, particularly in a market that for so long appeared so one-sided in terms of positioning, that kind of nuance is quite important. And I have to wonder, how complacent are we still? I mean, that fade yesterday was not a good sign.
No, there wasn't. But again, we got the S&P, up 1.6% here today. The Russell up 1.5%. The Nasdaq up 1.8%. So kind of some broad market moves higher today.
Yeah, and the VIX at 25. I remember those days where it was 12, 2 weeks ago. All right, coming up, Brian Whalen is Chief Investment Officer and a Generalist Portfolio Manager of a TCW.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Stocks advancing after a drop in initial jobless claims seems to be reassuring markets that the workforce is kind of reverting back to its pre-pandemic trend. We'll start with the NASDAQ, up more than 1.5%. The Dow up more than 1%. We have the S&P 500 up 1.5%, or 78 points. I want to take a little closer look. If you go with the IMAP feature of your terminal right now, we have information technology. That's where that biggest spike is coming from. You click through again, you get semiconductors, semiconductor materials, and at the top we do have applied materials. Applied materials right now up about 4%. We'll take you over to the bond market. The 2-year yield, 4.06%. That's up 9 basis points. And the 10-year yield at 3.99%. And that's up 5 basis points. Bitcoin, want to point it out, Bitcoin up 4%, 57,715. Major cryptocurrencies ticking higher. A big part of it, blockchain-based digital payment network Ripple. It was ordered by a U.S. court to pay a $125 million penalty, and that was just a fraction of what the SEC was looking for. That is your Bloomberg Business Flash. Paul and Alex.
All right, thanks so much, Lisa. I'm Alex Steele alongside Paul Sweeney. Welcome to Bloomberg Intelligence Radio. We are broadcasting to you live from Interactive Broker Studio right here in Midtown Manhattan. Also check us out on YouTube as well. What do you do in the market? The NASDAQ 100 is up by 2%. It has been an extremely difficult week in the market, if you count last Friday, just in terms of understanding where we are, where positioning is, and is the market complacent? I mentioned the VIX at 25. Joining us now is Brian Whalen, Chief Investment Officer and a Generalist Portfolio Manager over at TCW, joins us now. Hey, Brian, are we complacent here at this point, or is this a buying opportunity?
I think it's a buying opportunity in the bond market. We've had a little bit of a backup. I think everything we saw, earlier this week, Sunday night into Monday, was a bit of panic. We've been in a very bearish camp with regards to the economy, but even we're dismissing the notion of some intermediate cut. We thought that was a foolish way to think about the world. So I think this is kind of calm. This is the market kind of settling in here a little bit. Even though we've backed off in bond yields since the lows on Monday morning, if you just take a step back for a second, the 5-year as just kind of an indicator of yields has come down 50 basis points since we started the quarter. So since July 1, and that's a big move. And I think that's very much in line with, the notions and everyone in the fairy tale camp of no landing kind of being shaken a little bit. We've seen a couple of months of slowing economic data. And the one economic kind of data point that had been holding up that no landing camp, which was the headline payrolls number, that got knocked off a little bit on Friday. And so if you kind of forget the noise early in the week, this looks like kind of the right place to settle in.
Brian, when you walked out onto the TCW trading floor on Monday morning, what were your traders telling you?
It was, metrics didn't make sense. Things were moving all over the place. Liquidity was very poor. You saw the VIX, I think at one point it was at, intraday was well over 50. It was 60. Which looked, it was in the 60s. Yeah, it looked more like an absolute, it looked like a stock market crash. It did not look like a market where headline employee, the rate should have been 175,000 growth on the payrolls number, and it came in 114,000, and the unemployment rate went from 4.1 to 4.3. I mean, that's indicative of a slowing economy and a slower labor force, and maybe one that's weaker than the market was expecting, and it probably will cause the Fed to have to cut more aggressively than the market was pricing beforehand. But it sure wasn't panic.
Well, what did you make of the 10-year auction yesterday? It wasn't good. It just was pretty bad. We got the 30-year coming today. The 3-year was fine. Ira Jersey tells me I should care about these things.
I know.
What did you make of that?
It's the same thing I make of this morning. It's gappy price action. It's a nervous market. I mean, you saw, a little bit of supply. The street pushes it around. You got a higher yield this morning. Initial jobless claims come in just a hair under expectations, although the 4-week moving average keeps moving up. Continued claims continues to stay high. So the fact that we're off 10 basis points in the market is it's a market trying to find its footing, almost trying to like catch its breath a little bit, which is a healthy thing. I think what we would contend is, this is maybe not the breath you take because everything's going to be all right. It's more like the breath you take before you take the punch. And so, over the next few months, what we're probably going to see, at least we expect, is more of the same, which is the economic data continuing to slow, and the Fed's going to have to react to that.
Brian, where do you see opportunities in the fixed income market here, given some of the volatility we've seen over the last several days?
It's a boring answer. I'd say the opportunities, maybe agency mortgages aside, but at a high level, the opportunities is in duration and in liquidity. Like keep your powder dry, because not saying we're going to have VIX days of north of 60 again, but if we enter the fall and the narrative, and you start reading more about a recession, and the job market turns from one of where companies are just not hiring, but actually starts to fire, what you're going to see then is concern about earnings growth and the ability of companies to service their debt. And then there's going to be conversation around downgrades and what happens then in terms of pricing and like our trading floor and the opportunities we're looking for. Corporate bonds are going to get cheaper relative to treasuries. High yield bonds, emerging market bonds, they're all going to get cheaper. And that's a really nice buying opportunity, because in the bond world now, not only can you kind of buy cheap credit and get the benefits of spread duration, and that's another conversation, but you can also get carry, and you can also get the advantage of like diversification in your portfolio, because with yields across the curve right now at 4%, bonds can be bonds again, so they can act as that hedge and that offset into an environment where we get volatility and equities decline.
So two things with corporates. One, we saw a record amount of issuance yesterday in the investment grade market all year. And then also the spreads have not blown out at all, like in the last few days. Yeah, they moved up, but we haven't blown out. And I'm just wondering if there's more price depreciation here to come.
Definitely. It's $1 trillion, a little over $1 trillion of issuance year to date, which is very high. But yeah, look, like just to put things in kind of context for everybody here that doesn't watch this stuff day to day. I mean, investment grade corporate bonds kind of on the tight end, meaning like the amount of yield you get over treasuries, doesn't get much tighter than about 0.8%, 80 basis points. We're sitting at about 100 basis points. Historical averages, just even excluding like big moves like the great financial crisis, historical averages are about 120, 125 basis points. So, that was kind of us too on Monday, when it's like, look, the market, everybody's got to calm down a little bit. Like, at 100 basis points over, corporate bonds still look expensive. So be patient. This may not be a recession that we kind of jump into in an overnight. This just may be an old-fashioned recession where we're just going to have to walk our way into it. And so as an investor, you got to keep that kind of long-term perspective in mind and preserve that capital. If you've got that cash, that's worth a lot, because you'll be able to spend it in very wise ways, probably throughout the remainder of the year and into early next year.
So, Brian, when the phone calls do come from Wall Street with these new issues, what kind of calls do you take? Do you take everything? I mean, because you've got capital to deploy. Are you focusing just on the highest quality stuff? What kind of phone calls do you take from Wall Street these days?
I think the way I've described it is like, don't call us when you think we need you. Call us when you need us. That is like the good way to describe what we call like the liquidity premium, which is, and I was talking about cash before, like, you want the opportunities when people are calling you on the phone and saying, we've got a problem, or somebody needs to sell, and et cetera. And it's like, okay, what you hear seems like going on to like a dealer's like car lot. Somebody's like, look, I got to get rid of this thing, blah, blah. Same thing. Like, as an investor, you want to wait for the opportunities where Wall Street calls you and says, look, here's an opportunity. Here's the price. I know you know where regular market pricing is. And, what do you think? And that's what you wait for. It happens kind of infrequently, but that's where you can make the big money.
Where do you think we're going to see the most volatility?
Oh, that's a good question. In the short term, we'll see it and obviously in interest rates. I think the next thing would probably be your what we call these high beta parts of fixed income, like high yield and emerging markets. I think down the line, so the public liquid markets will react first, and that's where you will see the vol. I'll also throw, we'll probably see some currency volatility in there too. But down the line, if we do get a true recession, there'll be a shakeup, in everybody's favorite market today, which is private credit. And there's some, private credit's here to stay, and there's some great things about it. However, it's been too easy for too long, and there's going to have to be a shakeout. And that's a healthy thing for the market in the long term. And so in the short term, focus on those kind of liquid markets like high yield bonds, for instance, currencies, and then in the longer term, that'll probably roll into less liquid parts of the market.
All right, Brian, thanks so much for joining us. Really appreciate it. Brian Whalen, he's a Chief Investment Officer. That means he's a big dude, and a Generalist Portfolio Manager at TCW. I tell you, I've worked with TCW when I was on the sell side, 20-some-odd years. I had like 4 or 5 relationships, good relationships there, all really smart.
Super smart.
Yeah, I mean, like across the board. Like I avoided the fixed income floor like the plague. I went to the equity floor because that's more
So I think that people
stuff.
are really smart when they can break things down in language that I understand.
Right.
Like that's the pure sign. Like you're so smart, you can dumb it down.
Right, and that's how Brian Whalen.
Paul's guiding principle was, where can I make the most money?
Where can I make the most money?
As he should.
Exactly.
As he should.
I tell you, go to Los Angeles, there's 2 meetings you have to get. TCW and Capital Group. Everything else is just gravy. If you get that, that's like 80% of the votes, 80% of the commission dollars out of those 2 shops.
Yeah, duh, Tucker. God, you didn't know that. Jeez. All right, coming up, you got Michael Halen is joining us. Bloomberg Intelligence Senior Restaurant and Food Service Analyst. Restaurant brand earnings were actually not that great. I remember we also had like Monster Beverage raising some prices, Burger King, Papa John's, not doing so well for restaurant brands. We're going to break that down. In the meantime, though, you're looking at equity markets still up. NASDAQ up by full 2 percentage points. The S&P up 1.7%. A big move today. Will it hold? Here's John Tucker with World and National News. John?
All right, Alex and Paul. An alleged attacker detained by Austrian police had been planning to attack concert goers at Taylor Swift's show in Vienna with homemade explosives and knives. This according to Austria's intelligence chief. Police say 19-year-old Austrian citizen likely had planned the attacks alone, but was in contact with at least one person who was slated to work at the concert venue. The foiled plot prompting the organizer to cancel all 3 shows in Vienna that were part of the final leg of Taylor Swift's sold-out Eras tour. Now a sprint through the key battleground states for Vice President Kamala Harris and her new running mate, Minnesota Governor Tim Walz.
Donald Trump, he sees the world differently than we see it. He has no understanding of service because he's too busy servicing himself.
Governor Walz spoke there in Detroit. Meanwhile, his opponent for the vice presidency, Ohio Senator J.D. Vance, was tailing the Democrats. He spoke with reporters by Harris's plane, Air Force Two, in Eau Claire, Wisconsin.
We think it's important to get out there, to talk to people, to make the best case that we can. And obviously there's an element of, especially local media is going to cover her because she's the vice president and the presumptive nominee. So we think it's important to have a counter narrative here, and importantly to drive home this point that she has been a dangerous radical.
Meantime, Donald Trump plans a news conference this afternoon at Mar-a-Lago. Bloomberg Radio and TV will carry it. That's expected around 2 o'clock. And Tropical Storm Debbie making a second landfall in South Carolina. It's now on its way up the East Coast, where residents as far north as Vermont could get several inches of rain this weekend. Global news, 24 hours a day, whenever you want it, with Bloomberg News Now. I'm John Tucker, and this is Bloomberg.